China data, giving a little bit back this morning. But gold is JP Morgan's top pick. It's going to make $2,500 for them by the end of the year. This is their #1 pick for 2024. The Chinese central bank has been a key buyer there. So another record in on gold. If you're a little bit worried about sticky inflation. Now, my next guest writes this: there is an abundant evidence of no bubble in risk assets. If anything, we could be in a 2017 style backdrop where risk assets continue to grind higher. That is Max Kettner, Chief Multi-Asset Strategist over at HSBC. Max, good to have you with us. So reverse Goldilocks is no more. That was your January call, a 2017 style scenario for markets. How much of a further melt-up can we have? Because you would say we're not even really overly exuberant in US equities thus far.
Yeah, good morning, Manus. I think we can go quite an awful lot still from here. Quite simply, when we look, for example, at 2017 and compare that with where we are right now, I think one thing is quite similar. It's sentiment and positioning. So on our measures, when you look, for example, at the sort of the aggregate sentiment among the largest real money asset managers, sure, it's no longer as bearish as it was 6 to 12 months ago. That was one of the key reasons why we were so bullish on risk assets overall last year. But what we're seeing currently is that people are basically sort of neutral everything. They're ever so slightly overweight in equities, but really neutral in credit, neutral in investment grade and high yield, even neutral in duration. So no real conviction there, right? So to us, I think that is one of the big similarities to 2017, where the macro environment also looked pretty healthy, pretty strong. People were talking the bullish talk, but they weren't really walking the walk, right? They were kind of stuck in saying, well, you know, I am pretty bullish, I am talking bullish, but I can't really buy an S&P at an all-time high. I can't buy IG credit at 80, 90 basis points. I can't buy high yield below 300. So I'm going to wait for the dip, and when the dip comes, then I'll buy it. And I think what's similar now is that everyone is sort of really waiting and desperately waiting for that dip. So to us, you know, other than a couple of percent perhaps lower in equities and a handful of basis points up in credit, I don't think there's going to be more substantial of a drop than that. And to us, that means every kind of really little drop that there is in risk assets, you're going to have to jump in very quickly.
Given what you just said, do you think there's a form of paralysis in risk-taking, even though prices are being marked higher? You would therefore say participation is lower across the asset spectrum?
I think there is, yeah. I think absolutely. I think there is still an awful lot of conversations, at least that we're having, about sort of the binary risk, about the Fed, about the ECB, the Bank of England, right, about central banks in general, where people are saying, well, can they really cut? Can they afford to cut with such easy financial conditions, such loosening of financial conditions? Can they afford to cut with such solid growth momentum, with such a tight labor market, with non-farm payrolls going still up, and all of those things? And I think once the cat is out of the bag, once we perhaps, hopefully, do see the Fed cutting in June, right? Once the cat is really out of the bag, I do think there is still quite a bit of a potential for risk assets still to rip higher. It might be a bit different in the second half, right, towards sort of Q3, Q4, where earnings expectations are really quite a bit punchier, where perhaps, you know, bank reserves might be going down with the Fed's QT. But that's something to ponder about in, you know, 6 months' time, not for the next 1 to 2 quarters.
But your thesis is not built on whether it's 3 cuts or 2 cuts. Your thesis is built on the principle of starting a cutting cycle. Given what you heard from Powell, you've got the PCE data, cooling services PCE coming in nicely in line with what the market wants. But then I look at what Powell talks about. We need more good inflation data, similar to last year. We don't need to be in a hurry. I put it to you that Powell is converging towards Waller, and that is perhaps a more prescient risk.
Yeah, absolutely. I think that would have been the risk for last year. And to be fair, that was the risk that we were seeing at the start of the year, right? Where inflation expectations at the front end were already below 2%, right? And where we've seen these sort of 7 to 8 Fed rate cuts in the price. The point now is that, you know, expectations aren't so dovish anymore that they can be massively disappointed. I think it would be very different if the market was still pricing 7 to 8 cuts and suddenly, all out of the blue, Fed and Waller would be saying, oh, you know what, we're only going to cut twice. You know, then you're going to have a big trouble. You're going to have big trouble because there is this big repricing potential. We don't have that anymore, right? Now you kind of go like, well, if it's 2 or 3 or 4, who cares, right? For risk assets, really what matters is the start of the cutting cycle. It's this binary thing. As long as they cut, I think there is still so much money on the sidelines, so much money in money market funds, in cash, right? In large cash holdings that can then be deployed. In a second stage, again, during, you know, perhaps the second half of the year or in 2025, that's the bigger question then, right? Can they really cut all the way down to 2.5% to 3%? Or might they be stuck at 4 to 4?
But do you not think that you need some kind of a crisis, Max, in I was going to say crisis in markets. Do you not think that you need some material tail risk event to get you to 2.5%?
Yeah, probably. I think, you know, getting to 2.5% certainly over the next, let's say, 12 months looks pretty unlikely, right? Yeah. Looks really pretty unlikely unless we get all of, you know, out of the blue non-farm payrolls going down 200,000, you know, a month over the next 3 months. But that, you know, no data indicates that at all. If anything, it goes the other way. If anything, what we've been seeing when you look at things like CEO confidence, when you look at, you know, consumer sentiment among their own or regarding their own finances, which is important for future consumption. Look at global manufacturing leading indicators, right? Look at now central banks going from cuts to from hikes to cuts. So we should be talking about the lagged impact of easing, the tailwind for growth. A lot of those indicators are increasingly looking like early cycle, not like late cycle. So as you said, right? If we saw all these late cycle indicators and perhaps these sort of, oh, there's a recession warning, then you could make the case for those tail risks coming. But we're actually seeing more evidence of the other side, right? Of the opposite right now.
Okay, and we're certainly eyes down on those jobs reports. 400,000 is what we're looking for a 4th month in a row. And by the way, there is a wonderful line there. We've got record highs in Canada, in Taiwan, the DAX, the Nikkei, all of them going into syncopated record highs. Haven't seen that since 1985, Max. Stay with us. We've got more work to do. Max Kettner setting the agenda this Monday morning on Bloomberg Brief. Other top stories that are trending on the Bloomberg terminal this morning. We have salvage specialists starting the daunting task of clearing debris from the destroyed Francis Scott Key Bridge. Ports along the U.S. East Coast are modifying their operations to absorb the cargo diverted from the Baltimore harbor. The fallout is expected to be largely contained as neighboring facilities with spare capacity tweak their schedules. Tesla is increasing the price of most popular Model Y sport utility vehicle. The hike was widely telegraphed for several weeks, and China's automakers are piling in to take advantage, offering sweeteners such as subsidies and coupons to lure would-be car buyers. Shares at AT&T are falling, as I said to you this morning, pre-market trade. The telecom giant said that personal data of 73 million accounts was leaked over the dark web. The data, leaked about 2 weeks ago, includes personal information such as social security numbers and appears to be from 2019 or earlier. The FT reports that Shein's net income more than doubled to over $2 billion in 2023. This data comes as the fast fashion company waits for regulatory approval for its listing in either New York or London. The China Securities Regulatory Commission and Cyberspace Administration of China are expected to approve Shein's share sale in the coming weeks. Coming up, we'll dig into that data from China, boosting the optimism for reaching the nation's hallowed 5% growth target. More on that story. And later this hour, we'll look at the economic week ahead with Michael Skordelers of Truist on Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
That's doing a lot better than we initially anticipated to start off 2024.
Of course, we've got the property sector. I know we're going to check iron ore prices later on. I mean, it's really struggling to find a floor. Is there any kind of floor-forming narrative in the property market, or do you think there's still more pain to come in that sector?
No, I mean, Manus, this is what we're talking about when it comes to the economic recovery this year. It's kind of a two-track sort of system, right? So on the one side, you've got all of these, this industrial activity that's really picked up, foreign demand that's really picked up, but the domestic demand side of things really still is obviously struggling. I mean, we talked about the property sector. We saw home sales continue to slide in March. We're really not seeing any floor put under things there. And that's a really troubling month also to see that continued decline in home sales, because that's period in the spring when you start to see those property sales pick up. We also saw the central bank just about a month or so ago try to, cut some, banks were cutting their lending rates, trying to spur activity there. This is really, really not recovering. And when you combine that with some of these ongoing deflationary pressures that we're seeing from the Chinese consumer in China, it's really just telling us that that's still a part of the economy that has a long ways to go toward recovery.
Okay, Jill, thank you so much, Jill DeCease, on the latest China data. My guest this morning is Max Kettner, Chief Multi-Asset Strategist at HSBC. We should be grateful for a bounce in the PMI, a leveling off, a nice Chai-Shin. Lots of funds are flowing into emerging markets because that is where the value is. Do you think that China has displayed enough data to warrant a reallocation and an upping of the allocation to China equity and credit? Max?
Yeah, look, I think it is the flow perspective is actually very, very interesting because when we look particularly at the second half of last year, foreign investor flows were obviously tilted massively towards outflows. So we have seen, in particular in 2023, and in particular in the second half of 2023, quite substantial foreign investor outflows. We have seen after these hopes for really a swift rebound after the lockdown at the beginning of 2023, we've seen really also consensus expectations, be it on the earnings, but particularly on the top downside, consensus expectations being slashed massively. So, we wrote a note a couple of weeks ago where we looked at really most of the risks markets are facing or are going to face most likely in the next couple of quarters. And China is one of them, where we really argued, well, actually, we've seen these kind of significant foreign investor outflows. We've seen this trimming of growth forecasts in the last 6 to 9 months. So indeed, if we were to see perhaps this kind of momentum that we've seen in the last couple of months, if we saw this continue, I don't think this is going to be a massive downside surprise anymore for markets. It's not going to be a massive downside surprise for risk assets in general anymore, because we've seen these outflows, because we've seen the slashing of growth forecasts. Whereas on the other hand, if we were to see data like we've seen in the last 24, 36 hours, if we were to see more upside surprises, I think that is unanimously positive, right? And that could be even positive for Chinese equities. I would at the moment also say, things like long oil, long energy are a really good play because we are seeing global manufacturing also rebound, not only in China, but really globally as well. It is also perhaps a little bit of a geopolitical hedge, but also when you look at Europe, of course, European equities have done phenomenally well on the large caps. But look at the small, look at the mid caps. That's where the pain is. And that's where perhaps if China does recover a little bit and does surprise to the upside against a pretty low bar to beat, that is, that should be quite a big boost for those European small and mid caps as well.
I don't think I've actually heard you quite as bullish in a very, very long time. No, I'm quite serious about that. And to that point, you not only make it clear about the lack of participation and where we can go, but you also call on oil. You remain overweight oil. And that is in many ways your play on global growth. To what extent will that embolden a broadening of the equity rally max, if at all?
Yeah, perhaps the bullishness has to do with the long weekend, right? Give me a long weekend and I'm becoming incrementally more bullish, perhaps is that. No, but in all seriousness, I guess when we look at the broadening out, I do agree with the overall theme. I just don't agree with perhaps, things like US small caps, long the Russell 2000, for example. I don't agree with that because let's remember that in the Russell 2000, you've got around 40% of the companies, even more than that, slightly more than 40% actually, that make no profits, that sit on negative earnings. And we have in the Russell 2000 a debt maturity profile that is largely skewed and heavily skewed, in fact, towards floating rate debt, right? So if indeed the data comes in stronger, I think those companies will be a bit in trouble through perhaps the floating rate profile. And if we do see some downside surprises, like we were talking about in the first segment, that could be a bit negative for the Russell. So broadening out, yes, but more within the large caps. Energy, materials, consumer cyclicals. Stick to that.
We got to leave it there. Enjoy the rest of your Easter Monday vacation. Max Kettner, my guest this morning, setting the tone on Bloomberg Brief.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Brief. I'm Manis Krani in New York. The Turkish President Erdogan suffering an unprecedented loss in local elections amid rampant inflation, the highest borrowing costs in 2 decades. Patrick Sykes is with me in Istanbul. This is a bit of a shocker, isn't it, in terms of the polling for the AK Party?
That's right, yeah. It was expected to be a very tightly run, close race, neck and neck. Instead, the opposition have really blown Erdogan out of the water, and they've eaten into his heartland territories as well, some of those key conservative voter bases. I think now the thing markets will care about is, do they continue under Erdogan with the current economic program, which is expected to reel in inflation, but be quite painful in the process. For now, the message from him and his economic czar, Mehmet Şimşek, is a clear yes. Erdogan said it yesterday, Şimşek said it today, just an hour or so ago. But yeah, the question is, I think, whether he's got the patience for that pain that this program is likely going to involve.
Look, what was behind the win for the opposition? Was it the 50% interest rates? Was it the inflation? What is it that's biting on the ground?
I think 2 things. The main thing, and the sort of most visible one, is the leadership, right? In the May presidential elections last year, where Erdogan won, the opposition was divided. It was led by a sort of long-time leader who wasn't the most inspiring, also came from a religious minority that not everyone felt comfortable supporting. This time, it's the incumbent Istanbul mayor, very charismatic. He's got good outreach to Kurdish voters, with women, with more conservative voters. So he's able to reach out more broadly than that traditional opposition base, which has historically been this secular Ataturk's party. And then more broadly, I think they were able to tap in across the country with what's clearly a sense of disenfranchisement with Erdogan and his party, with the AKP. That's what we read from these changing dynamics in the incumbent provinces.
Patrick, thank you very much. Great upsum there from Istanbul. Coming up in the show, look ahead to this week. It is counting down to the jobs report. My next guest joins me in just a moment.
My greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold.
The way I think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called the culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits. That's like, again, like a superorganism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Gone, the core PC is behaving very, very nicely, and so that emboldens the bond narrative and the equity narrative as well, also bid up. You've got consumer spending, strong, robust. AT&T under a little bit of pressure this morning. They've got a data breach, but for now, we start Q2. We've just had a very, very bullish narrative from Max Kettner. He's left reverse Goldilocks behind. He says participation, he said this could be reflective of 2017. The market's just getting going. So a very bullish call from HSBC across the multi-assets. Roll it forward, have a look at the bond market. I think we're about to tick lower, 1 basis point lower on the bonds. This is what we've got for you. Yeah, you've got crude flat at the moment. Gold, JP Morgan going for a record call on gold. $2,500 is where they go. It's their #1 commodity pick for them. Oil, you're just seeing the Permian Basin players playing into this demand for crude as the sanctions on Russian crude begin to bite. We'll talk more about that in a moment. And yields trade at 418 at the moment. So the US inflation data, the figures that we had on Friday, did very little to alter the views that the Fed will cut interest rates this year, most likely in June. The chair, Powell, spoke at the San Francisco Fed to discuss the data.
My first thought was that the report that came out this morning is pretty much in line with our expectations. So core PCE, as you mentioned, is at 2.8% on a 12-month basis. Headline is at 2.5%. That's what we were expecting, and it's good to see something coming in line with expectations.
So as you and your colleagues at the Fed and at the regional banks have been saying, we want more data, more good data. Is this that? Is this in that bucket?
Well, let's take a step back. Over the course of the second half of last year, we got what I would definitely consider good data over the course of 7 months. And then in January of this year, we got a very high reading, much higher reading on inflation. And so February is lower, but it's not as low as most of the good readings we got in the second half of last year, but it's definitely more along the lines of what we want to see. What we've said is that we don't see it as likely to be appropriate that we would begin to reduce interest rates until the committee, the Federal Open Market Committee, is confident that inflation is moving down to 2% on a sustained basis. And what do we need to get that confidence? It's just more good inflation readings, like the ones we were getting last year.
That was the Fed Chair Jay Powell speaking on Friday at the event in San Francisco. Joining me now for more on Friday's inflation data and the week ahead, it is our very own Bloomberg's Mike McKee. I mean, it's a busy week for data, Mike. We've got a lot of Fed speak. Just reflecting on what Jay Powell, I mean, he wants to see more of what he had last year, sort of before they pulled the trigger, pretty much in line with our expectations. But he wants to see something much more substantive before they pull that trigger.
Well, we saw both Chris Waller and Jay Powell last week sort of taking a new position. Yes, they want to see what they saw last year in terms of inflation, but the decline in inflation has slowed down a lot, while the economy has been growing faster than they anticipated. And so that raises the possibility that inflation could reignite, so they want more evidence that inflation is not going to go up if the economy continues to grow, and they seem to be more convinced that that is what is going to happen, that the economy is going to continue growing.
It almost feels as if Powell is converging towards Waller in terms of the narrative there. The Fed speak this week. To what extent do you think that that will coalesce? I mean, we're going to get the jobs report on Friday. We're expecting, again, a continued strong jobs report, 200,000 jobs created, tame unemployment. So what do you think the Fed speak is going to be? Do you think it's going to be Waller-esque or Powell-esque, or is there a general converging?
Well, what's interesting is we get a lot of different data this week. We end with jobs, but we begin with today the ISM manufacturing numbers, which will be important. We get the JOLTS numbers, which have affected the Fed and moved markets, ADP, jobless claims. So we get a lot of jobs-related numbers that could lead people to maybe change some of the way they characterize it. But I think basically what you're going to hear from most of the people who talk about monetary policy, and we get Jay Powell again doing that, is basically the same message, that as of today, April 1st, we're not ready to cut, or this week in April, we're not ready to cut, but it's out there somewhere. We just have to see the data cooperate.
I mean, since Thursday through to today, we've seen the betting increase that June, it's over 60%, that June is a lock live to begin the rate cutting decision. But it is close on the dots, isn't it, between 3 cuts and 2 cuts. We just had Max Kettner saying, look, it doesn't matter whether it's 3 or whether it's 2. It's the principle of this beginning, this cycle beginning.
Well, that certainly will be a pivot point for the markets. Then they will start pricing in cuts at meetings after that. But remember, they looked for 6 cuts when we went into this year, and now they're thinking, well, maybe the Fed is going to do 2. You can see the way July has moved here. July was almost priced out on Friday when the PCE numbers came in stronger and Jay Powell spoke. Now, this morning, as the U.S. gets back to trading, we are seeing some movement back to July. July is the first month in which we're seeing a full pricing of the rate cut. And that's going to move around as we get the data this week and as we get additional speeches and as we get closer to the next meetings. May 1st, there's no new update from the Fed on the dot plot, but we will hear a lot from them going into that meeting about where they are. And so you could expect a lot of volatility still in these numbers.
Okay, Mike, thank you very much. We've got a busy week ahead of us. Let's bring in my guest. It is Mike Scordelis, Head of Economics at Truist. Mike, good to have you with us. So we've had very, very solid, concrete, contracting services inflation. Why the hesitation in Powell? It does feel as if Powell is moving towards Waller in terms of his narrative. Your take on the PCE and the rhetoric?
Well, the first thing, thank you, Mass, for having me. More importantly, patience is the order of the day, and that's what I think the more important narrative to really pick up on. If we wait till June, we're talking about getting March, April, and May data by the time we get to that June meeting time. And yes, the inflation data has been cooperating. On the other hand, we've seen a number of largely global things happen. Both the Suez Canal issues, along with the ongoing Panama Canal issues that have pushed up global shipping costs. That's a real risk. Additionally, now we have this issues with the Baltimore port, among other things. There's a reason to have a little patience and not be foaming at the mouth that there's going to be a rate cut the way there was earlier in the year, as you and Mike were just talking about. Like, people expected 6 or 7 cuts. We weren't going to get 6 or 7 cuts. It really breeds a need for patience.
With that patience in mind, as Mike just said, July is the first month where you've got a full lock, a full cut in there. To ensure a soft landing, and it's interesting because Powell, post the Fed meeting, talked about restrictive rates. To ensure a soft landing, do you need a de minima of 2 cuts? Or do you just need tokenism, or do you need something more than tokenism?
Tokenism definitely works just as well. Markets are convinced that we've already seen the peak in rates, and I think that's the more important take-home, is that we're not going to see additional rate increases. Whether they cut once, twice, 3 times, again, that's not as material for what's going on in the economy. The overall growth trend has slowed down from that really strong second half of 2023. We're seeing that across many different data points. On the other hand, we're heartened by the fact that the downside seems to be limited. So manufacturing seems to be perking back up, not just in the US, but globally. And we're seeing the housing numbers, which had been literally, collapsed through 2022 and 2023 because of the dramatic increases in rates. So the downside seems to be limited, and the upside seems to be, fairly rosy looking ahead. So again, I think the patience is the order of the day.
The bond market has, on a number of occasions, tested this ceiling, as you point out, at 435, but it's failed to break through the why.
Well, I can't tell you the why it hasn't broken through that 435. I wouldn't be surprised that it breaches it at some point. There could be an issue. Maybe it's related to the port dynamics that I was mentioning earlier, that there could be some supply chain issues or what have you. There might be a reason, or a hotter print on the inflation side. That said, at the end of the day, inflation trend where we're seeing it today, it seems to be all about shelter. And the shelter numbers, whether we're talking about spot rents, prevailing existing home prices, etc., they are moving in the right direction. No, they're not moving down as fast as a lot of people want them, those that want the 6 or 7 rate cuts. But overall, the economy is in good shape, and we've been talking about a stronger for longer sort of scenario.
Where are we on duration? If we're going to trim back to, let's say, 1 stroke 2 cuts, tokenism, but it's about intent. It is about intent of the beginning of a cycle. Is that enough to add duration now?
Probably not. And I think that's why they want to have a little more clarity on when those cuts are going to be and how dramatic they're going to be. But we just don't see the need to have a 3-4 cut sort of regime, certainly in 2024, but even looking forward to 2026, 25 or 26, where a lot of people are trying to say, as soon as they start cutting, it's going to be 150 or 200 basis points total. We just don't have enough data to base that sort of scenario on. Something else has to happen. And we don't see that something else being a negative. We don't see that something else on the horizon today. That doesn't mean that it won't get there, but we don't see the reason or the impetus of why they need to cut dramatically. So that really muddies the water in this duration discussion.
Okay, Mike, let's see what we get in terms of Fed speak through the week. That is Mike Scordeles of Truist, my guest this morning on all things macro. Quick snapshot of what's going on in the iron ore market. Yes, you've had healthy PMIs come through. It's up at the moment over 2%, but still there are questions around the housing market and whether it has actually managed to put in some kind of a floor. But that is debatable. You still got a home sales drought. Top real estate companies, the sales are down by 46%. So we had initially based out on iron ore, but we are managing to claw our way back up over 2%. Coming up, oil continues to rise. You got the surge in China demand causing a solid first quarter, up 14% in the first quarter, just leveling off as we go into the start of trade in New York at the moment. 83.08 on Bloomberg.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and where the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's your Monday edition of Bloomberg Brief. I'm Manus Cranny in New York. We're checking in on the oil markets. It was a solid first quarter, signs of a recovery in China, boosting the demand outlook. We're just flat at the moment, down an eighth of 1% on Brent at 86.88. Anthony DePaula is with me on the oil market. So the sanctions are beginning to bite in terms of Russian and Venezuelan oil. What does that mean for American producers? Anthony, good morning.
Good morning, Manus. How are you? Yeah, we're seeing that situation mainly on the Indian market, for example, where buyers there have stopped taking some of those Russian barrels that have been on vessels that potentially have been sanctioned by the U.S. or singled out. And so that's an issue for the buyers there, as they are hesitant to take into some of those cargoes. And the possibility of renewed sanctions on Venezuela has also stopped some of those producers from taking some of those barrels. And so that's pulling in West African and U.S. crude into India. And we're seeing a lot of that additional demand for U.S. crude from some of these buyers who are hesitant to take barrels that might give them problems because of additional scrutiny by the U.S., by the U.S. Treasury, possible issues with the vessels. So we're seeing a lot of those concerns around, and of course, the U.S. production just keeps going up, and that is giving more fuel to that fire of those rising exports, as we've seen records set for several months over the last year since that Russian invasion of Ukraine, and since that caused such a tumult in energy markets, Menace.
It's going to be a delicate one for the OPEC Plus nations, isn't it, in terms of adding back their barrels, because they want to see the $100 oil. That's what JP Morgan are talking about, $100 oil's back on the table. How delicate a balance is it for OPEC Plus at the moment? They have extended their cuts through to June.
Yeah, we're in for it throughout the rest of this year as we watch OPEC look at that market, gauge when they can come back in. What we're seeing now is that monthly gain oil, as you said, holding some of those gains from a stronger quarter. And what we were seeing there is that tightening in the market by OPEC as they keep some of those barrels off. The challenge for OPEC, of course, is that there is so much non-OPEC production coming on. We've got oil coming on in the United States, in Brazil, in Guyana, and that oil is expected to make up for a lot of the demand gain that we're expected to see in the market this year. If some of those actual demand is higher than what has been forecast, we could see it a little bit easier for OPEC to bring that oil in by the end of the year. But we're looking at a little bit of tightening over this first half, and then some of the analysts are forecasting then a deficit towards the end of the year, where that should be the sweet spot that OPEC is looking at to bring some of that oil back. They've got a meeting of the consultants and the experts this week, which isn't expected to make any recommendation for any change. So we'll be seeing that going in, I think, Manus, from the second quarter and then into the second half.
Anthony, thank you very much. Anthony DiPaolo there in Dubai, tracking the oil markets for us. Turning now to the consumer sector. Walgreens is narrowing its fiscal 2024 guidance, even as the drugstore chain beat Wall Street's estimates for the second quarter profit and revenue. Walgreens CEO Tim Wentworth joined Bloomberg last week to discuss consumer behavior.
I think what you see is that the consumer continues to behave in ways that show that they're challenged. They are seeking value. They are willing to bulk purchase and do other things. So when you look across the retail spectrum, you'll see some folks doing better than others if they're in the super high value part of the ecosystem. In our case, obviously, we count on folks to come in and to not only visit our pharmacies, but also come in, buy impulse items, get last-minute items, get seasonal items. And a lot of those things are purchases that you've got to get the value equation right on, or else they feel discretionary to folks. And so we have been re-engineering our experience, our SKUs and our product line, and our pricing strategy and promotion strategy to bring back those that we've lost and to keep the ones that we've got. And what you see is we are anticipating the second half. That is not going to meaningfully dissipate, although I also don't think it's going to get worse. I think we have got ourselves positioned to now build from the second half of this year back to a place where consumers will begin again to prefer Walgreens more often than they do today.
Tim, does that consumer behavior extend to both your store footprint and your digital offerings, or are you seeing any discrepancy in those two marketplaces?
No, it's interesting. Our digital offerings have really proven to be not only robust, but important parts of holding up our underlying value, both value to our shareholders, but also value to the consumer. So we see meaningful increases of same-day delivery. 80% of our deliveries are actually done within an hour, not a day, not 2 hours, 80% within a day, slightly over 80%. And so we've seen the investments in both the underlying technology to enable the consumer to interface with us that way, and then the underlying ecosystem to get it reliably to them has meaningfully brought consumers back into the fold.
Tim, a big part of that technology is built and executed on by DoorDash. I know that you are only a little period into your tenure as CEO at Walgreens, but what have you made of DoorDash and the relationship there?
Yeah, we are really pleased. I will confess to you, coming in, I wasn't certain how to sort of think about that. Obviously, we were not in a position to build a distribution system, store door, all the way to people's houses with our own vehicles and so forth. It's not necessary. DoorDash has been a great partner. They deliver, they communicate phenomenally. If you haven't actually used the experience, I recommend everyone give it a try. The communications from both Walgreens and from DoorDash throughout the journey of the product that you've ordered is phenomenal. And so they have been great. I am super happy with the results that we're getting with them.
That was the Walgreens CEO, Tim Wentworth, speaking to Bloomberg last week on the consumer. Snapshot of cross assets. We've just had a pretty bullish conversation with Max Kettner at HSBC. He believes that this equity market rally has quite a ways to run. We're up, in his view, 9% in the first quarter, and it's really not that stretched. Excuse me, frog in my throat this Monday morning. Yields down just 1 bip at the moment at 4.18 on 10-year government bonds and flat on the dollar as we kick into the second quarter. But Max's view would be is that positioning is not stretched across assets. Bitcoin starts this first trading day in New York of the second quarter on the back foot, down 1.85%. We're just seeing this little bit of a pause for thought. Obviously, it accelerated above that 70,000 level, so we are just down by 0.2%. Let's see how the cross-platform, I should say. We've got Coinbase down by 1.125%. So we're just seeing a little bit of a backstart on some of these crypto platforms this morning. Coming up, we'll take a look at some of the market-moving events throughout the week. The crescendo, of course, is your jobs data on Friday. Good morning from New York.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I think the Fed needs to be market-based and not academic-based.
I think they need to cut before they risk staying higher for too long.
We expect data that will be forthcoming to give them confidence. And it is the Fed's job to take the data pretty much at face value.
The best thing is to just be able to truly look at the data and stand by that, because no matter what they do, they're going to get criticized on the timing.
I'm really not as concerned about the Fed cutting rates. And as long as the economy remains strong, those earnings will be there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Kicking off a new trading week, a fresh month, a clean slate for another quarter, and leaving behind some stellar gains in Q1 and hitting the ground running in Q2. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance, an absolutely stacked show for the first hour for the month of April. I'm Jonathan Ferro. Alongside me, Anne-Marie Hordern, together with Laurie Cavacina of RBC for the next 60 minutes. Bramo extending a ski trip by an extra day, needing the extra rest because the week looks like this. Absolutely relentless. PMI and ISM data today. Tuesday, jobs data. Wednesday, ADP jobs and comments from Chairman Powell. Thursday, jobless claims. And Friday, US payrolls to round out the week. And if you want a sneak peek of next week, we've got CPI and bank earnings, Anne-Marie, kicking off as well. That's quite a start to Q2.
Absolutely, a huge start. It feels like we just heard from Chairman Jay Powell, because we did on Friday. Now he's going to be speaking on Wednesday ahead of the all-important jobs number. Jonathan, the market, the survey, early forecasts are looking for 200,000 payrolls to be added. What is interesting, though, since the start of 2023, those payroll reports have been revised 7 times. So everyone kind of looks at them and says, well, we might get another revision.
Laurie, let's talk about the start of 2023. So January data, boomy. Question we were all asking about February, would it confirm? There's a feeling that it didn't really confirm the boom of January. What are you expecting from the March data that we'll see this month?
So I feel like everything I've heard from companies, just going through all the earnings calls, I feel like things are still pretty strong. Like, I don't feel like there's any sort of imminent cliff that we're about to fall off of. Labor still seems to be pretty tight. Companies are being picky. I don't feel like there's been any big change. I mean, I feel like we're kind of exiting that, kind of point where everyone's saying the economy stinks. We're sort of stuck in economic purgatory. And it's, oh my God, is the economy so hot the Fed can't possibly cut? Like, that's sort of where we are.
You've got to reflect on the data we got on Friday morning as well. We've got the rest of the hour to do so. Ian Shepperton of Pantheon Macroeconomics referred to January as a fluke. After what we've seen over the last month or so, would you refer to the January data as a bit of a fluke?
So our guys have been saying the inflation data, there were some bumps in the road, and I think we sort of heard the same thing from Powell. So I don't know if we can handle too many bumps, but I think a couple of bumps were to be expected.
What was interesting, though, is that it was revised by 0.1% higher. When you look at that PCE, which is all important for the Fed, it actually was higher than inflation than they had thought. But Powell almost moved towards Waller here. What he had to say was a reaffirmation that they are in no rush to cut rates.
You'll get Powell Volume 2 a little bit later this week. Let's start this morning with some price action for you. Positive 1/3% on the S&P 500. We're set up as follows. In the bond market, yields just a little bit higher at the long end, virtually unchanged on a 10-year, 420. In the FX market, the euro going nowhere, 107.86 on euro dollar. Coming up this hour, Terry Haynes of Pangea Policy, as President Biden builds on his fundraising lead over Trump. Bloomberg's undercurrent on signs of economic recovery
in China, and John Ridinger Breen Capital ahead of payrolls on Friday. We begin with our top story, setting up the first trading day of Q2. Lori Calvasina of RBC raising her S&P 500 price target to 5,300 from 5,150. The story we see in the data today is that the strong move observed in the S&P 500 so far this year has been deserved. But some of our work suggests gains may be tougher to come by from here, and the stock market needs a breather. So, Laurie, let's get into the upgrade. It's a very subtle, slight upgrade. You've got a range of models to work through. Which one is the more constructive one, and which one is the less so constructive one?
So the least constructive one is sentiment. And, I'll couch that by saying we thought sentiment was a problem for a couple months. Nothing's really changed in the last couple months. We're hanging out at 1 standard deviation above the long-term average on the AAII survey. And that's consistent with kind of a little bit of a breather in the market, kind of flat returns over the next 3 months. And we haven't gotten it yet. The more constructive data points, I would say one is actually our earnings yield gap analysis. If you look when the earnings yield gap is flat and you go back to the late 80s, average return in the S&P is about 13%. So that can get you north of 5,400. If you look at the one that's changed the most since the start of the year, that's had the most bullish move, it's the economic data and the economic model. So to start the year, consensus was looking, I think, for around 1.3% on GDP for this year. 0 to 2% is economic purgatory. Stocks don't do well in that kind of environment. There's this constant, oh my God, are we about to have a recession? Does that sound familiar? That's what we've been, basically hearing the last, year or so, frankly. But now the data is pointing to about 2.1% this year, and 2 to 4%, a very favorable range for stocks. And I think the average return's around 12%, so that's what we've got baked into the model. Your most bullish year, you actually saw, I think, a move about 34% that year. Now, that's not baked into our model, but it just goes to show 2 to 4%, people feel good, and that's what we've just entered.
The character of this rally seemed to shift in the month of March. Energy started to pick up. The banks started to pick up. Tech pretty much did nothing last month. Barely got talked about. Do you think that's a sustainable trend going into April and beyond?
I think it is. And, we downgraded tech back in January. We look at median PE multiples when we pick sectors. I know the market is technically cap weighted, but stock pickers, people I talk to, portfolio managers, they're picking individual stocks. And if you looked back to kind of 6-9 months ago, your median tech stock was around the long-term average in terms of its forward PE. And that really shot up at the end of the year and was almost as expensive as the industrial sector, really just one of the worst sectors we saw. So we think you've kind of lost the valuation appeal. And I'm not even talking Bag 7 here, but just of your typical tech stock. And I think things like energy are very cheap, financials are very cheap, materials has been on the move, even utilities had a good end to the month. And that's a sector, a couple weeks ago started looking really attractive on our valuation model. So I think this market wants to rotate, and it's starting to happen.
That's what I was going to ask you, though. We've had a number of false starts.
Yeah.
Is this a real rotation?
I think it is. I mean, we're seeing it in terms of so many different parts of the market. Even small caps relative to large caps are trying to make a stand, and that's probably where you could have the most accusations of a head fake, because we keep thinking, it's looking exciting, and then it gets knocked right back down. But I think these things in energy and materials really generating some true excitement among people.
Rates seem to drive the rally in Q4. In Q1, rates did not drive the rally. It was kind of bizarre. The nature of what underpinned the move seemed to shift. Can you walk us through the relationship and how it's evolved between what's happened in rate pricing and what's developed in equities?
So we saw a very strange relationship emerge after SVB, where basically if you looked at 10-year Treasury yield moves, it was equating to growth outperformance relative to value. And I think there were a lot of things that drove the big cap tech stocks last year, but one of them, I think, was better balance sheets, and those, kind of Mag 7, at least some of those names. If you look at like net debt to EBITDA, they basically don't have balance sheets as a basket, whereas the rest of the market, has regular amounts of debt. So last year when we were seeing 10-year Treasury yields move up and Fed fears move up, one of the safety trades that happened was going into big tech. And now I think we're starting to see, sort of a different kind of Fed narrative evolve this year. There's been some rising angst, but still I think the cuts are on the table. Maybe that's going to break. We'll see. But I do think if the Fed can thread the needle here, sorry, that's a tough sentence to say, but if they can thread the needle here and we can sort of get to the cuts, interest rates can come down, they can, the economy is kind of a show me story. We stay above this 2%. I think you'll see things like financials do well, even if interest rates come down a little bit. Typically, you want interest rates to go up for those sectors. But I think if interest rates come down and we don't kill the economy, I think the cyclical rotation is really going to take off.
It's a question we ask a lot. Do banks need higher rates or not? based on what we've seen, it kind of feels like no, maybe they don't.
I don't think they do. I think what you want is a higher rate environment than what we've had in past cycles. I think you want them to come down a little bit so we can, sort of preserve the economy. I think they've just turned into this kind of very boring trade where they're the plumbing of the economy. And if the economy is humming along, which probably requires rates to level off and come down a little bit, then they do well, but then you have higher rates than what you've had in the past, and that's also good for them. So it's sort of Goldilocks.
So this is how this rally has developed, away from mega cap tech towards energy, towards banks over the last month, and people start to think about the rotation away from large caps and maybe towards small caps. Peter Chi of Academy is going to catch up with us in the next couple of hours, and he's looking for that move in small caps to continue. Is that something you can get behind?
I think that it should. I mean, and shoulda, woulda, coulda. I mean, I've been saying this for a while, but I think certainly if you look at the valuation data, it's middle innings. You're around a 15 times PE on Russell 2000. It tends to top out around 19 or 20, was down around 11 last year. It's very middle innings. You see the same thing on the CFTC positioning data. You've moved up off of net short levels, and down around 2022, by the way, they were recessionary in terms of how bad they were. So we're back to net long territory. We're at kind of the 3-year highs, not all-time highs. If you look at S&P or NASDAQ futures positioning, you're basically back to all-time highs, or you've been a little bit above them on certain indicators. So I see a catch-up trade in the small caps, and I do think they're a bellwether.
When you're looking at your models, this is all based on inflation moderating.
Yes.
What happens if inflation does not moderate?
I think that that's one of the reasons, frankly, I think things like energy and materials have done so well. Yes, there's some cyclicality there, but there are also inflation hedges to some extent. So I think you'll continue to see certain sectors like that do well. But if we sort of go back to this environment, right, where people are starting to freak out about balance sheets and interest rates are going to move up, and we start talking about hikes again, it could fuel people, to kind of go back to those balance sheet safety trades, which could end up benefiting big cap tech again.
So whether or not inflation moderates or not, energy is a sector to buy.
I think so. I mean, we left it as an overweight at the beginning of the year, and I was a little bit uncomfortable with it, but my analysts liked it. The valuations were cheap. The dividend yields were very high. The balance sheets have been cleaned up. And I just sort of looked at it and I said, all my bets that I'm making on positioning calls are about inflation moderating and the Fed cutting and the economy taking off. What if we're wrong on that? Energy seems like a nice one to have in your back pocket.
Just finally, and you're going to spend the next 50 minutes with us, I'm pleased to say, but what's the difference between irrational exuberance and rational exuberance? How far are we away from one, and how close are we to the other?
So I think you keep an eye on AAII. If you get to 2 standard deviations, and we're not there, we don't do it all that often, but I think that would be a sign of irrational exuberance there. And that, we sort of already look like it, frankly, on the CFTC data. We're back to 2020 highs of February. We're back to early January 2018 highs. Those stats make me very uncomfortable. But AAII says we have a little room to go before things get silly.
Does high yield credit make you uncomfortable? Because there's 2 ways of framing it with spreads this tight at multi-year tights. You can basically say it's reflecting strength, or you can say it's reflecting maybe investors taking things too far.
I go towards the strength category, and I'm not an expert on the high yield space. We do talk to our crew at RBC on that desk pretty regularly, and they tell me all the same things that I see on the small cap balance sheet data, which is that things are just, not as bad as they've been in past cycles. Things have really been cleaned up relative to history, and there's some sector differences there as well. But I tend to lead more towards it's a sign of strength argument.
Yeah, you're not alone. Kicking off Q2 with equities at all-time highs and credit spreads in high yield exceptionally tight. Lori Cavacina of RBC is going to be sticking with us. Equity futures on the S&P positive by around about 1/3 of 1%. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Heckes. Hey, Yahira.
Hi, John. Salvage specialists are starting the daunting task of clearing debris from the destroyed Francis Scott Key Bridge in Baltimore. Ports along the U.S. East Coast are modifying their operations to absorb cargo diverted from Baltimore Harbor. The fallout is expected to be largely contained as neighboring facilities with spare capacity tweak their schedules. Turkish President Recep Tayyip Erdogan suffered an historic defeat at the ballot box on Sunday. The lira weakened in early trading after Erdogan's AK party fell behind the country's main opposition, the Republican People's Party, in municipal elections. Support for Erdogan's ruling party is at the lowest on record as the nation battles rampant inflation and the highest borrowing costs since the president swept to power more than 2 decades ago. China's factory activity beat expectations in March, boosting optimism about the country's ability to meet its ambitious 5% growth goal this year. The Manufacturing Purchasing Managers Index rose to 51.1 on Monday. It's the 5th month above the 50 mark, which indicates expansion, the longest streak in more than 2 years. That's your Bloomberg Brief. John?
Hey, Yahira, thank you. Up next on this program, Biden's growing cash advantage.
Stake. Not a joke. I think democracy is literally at stake. We're at a real inflection point in history. Things are changing.
That conversation up next, live from New York City this morning. Good morning.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
Jobs numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
Live from New York City this morning. Good morning. Welcome to the program. Equity futures on the S&P 500 positive by a third of 1% following 5 months of gains on the S&P 500. Closing out March and closing out Q1 with a gain of more than 10% for the first quarter. Pretty solid stuff. In the bond market, yields just about unchanged this morning, 420.23 on a US 10-year. Under surveillance this morning, Biden's growing cash advantage.
I think our democracy is at stake. Not a joke. I think democracy is literally at stake. We're at a real inflection point in history. Things are changing. This guy denies there's a global warming. This guy wants to get rid of not only Roe v. Wade, he wants to get rid of the ability of anyone anywhere in America to ever choose. I mean, all the things he's doing are so old. Speaking of old.
Here's the latest this morning. President Biden extended his war chest lead over Donald Trump after raising $25 million at a star-studded Manhattan fundraiser. Trump's still holding on to a lead in most polls, but has less than a third of the funds of his opponent after racking up millions in legal bills. Joining us now is Terry Haynes of Pangea Policy. Terry, you've been saying this for a while, that maybe the former president has topped out. Are you starting to see that coming up in the polls?
Yeah, John, I think so. Yeah, the way I look at the election really is there's kind of 5 phases of it. The bad news is, of course, this is going to go on for a very long time. The good news is we're into the 3rd phase already. And in the run up to the conventions phase, and in part of that, you're going to see the polls kind of settle out a little bit into what most people think they are, which is instinctively, which is a pretty even race. And in that phase, what you're going to see, I think, is the Biden start making his case about why he should be reelected, why comparatively he's the safer pair of hands, and at the same time, you're going to see Trump's disadvantages, the topping out, happening as well, with a continued split Republican Party and continued independents that aren't for him. He needs both. He needs both of those to be strong for him in order to win. He's not getting it right now.
Well, one big disadvantage Trump currently has, of course, is the campaign funding and the money you can use to campaign around the country. Biden is beating him by millions and millions of dollars. But is the Biden campaign using this money correctly? Where and how should this money be allocated?
Well, two things on that. Well, three things really on that, Anne Marie. First, I'm not wowed by $25 million in Manhattan with 3 presidents when the entire financial system is basically in the major banks and all the rest are basically down the street. I see people hedging bets there a little bit. Secondly, what Democrats tend to do is pledge money. So pledge versus how much money is actually coming in is a subject that we all need to pay close attention to. Finally, where they ought to put it is in get out the vote efforts. Hillary Clinton had a whole lot more money than Donald Trump 8 years ago, and that counted for nothing, largely because it wasn't allocated well. And Biden is in the position of needing every single vote if he's going to win. So that's their top priority. The other priority they will use it for, frankly, is what gets called candidate suppression. Generally, making sure the third-party voters are as minimized, third-party candidates, I should say, are as minimized as possible.
We had an update actually on the third-party candidate in terms of a VP pick for RFK. Who does RFK draw from now? Is it going to be Trump or Biden?
Well, I think he probably draws more from Biden, but I think we learned a lot about Kennedy in the last week, and none of it's good for Kennedy. Kennedy, two things. One is he basically decided to become a niche candidate instead of a broad-based challenger. That's number one. Number two, he had a choice about whether to broaden his appeal or not. He's chosen not to broaden his appeal, and by picking what I think, frankly, is the wackiest vice presidential candidate nominee in American history, and I don't say that lightly. What you've got here is a niche candidate proudly proclaiming he's niche and proudly proclaiming that he doesn't have any money, so that's the motivating factor for him, period. Meanwhile, he's got a problem getting on the ballot, and he's got a huge problem, to your point, getting a message that is going to appeal to a lot of people. So, my 2 cents is Biden, I think, has him down, and over the next 6 months, Biden will go in for the kill and try to wring out any serious challenge that Kennedy might pose.
Terry, this is Lori Calvasina. I get tons of questions on RFK Jr. from non-U.S. investors. The other question they ask me is how confident are we, or what are our expectations regarding Congress? Most folks I talk to outside the U.S. think we're going to have a Republican sweep. And I tell them not so fast, but I'm wondering if you have any updated thoughts on Congress.
Yeah, of course, Lori. Two things. One is that there's a great hunger in the American public for an alternative to Trump versus Biden, but and an opportunity for a third-party candidate, but that's not happening. So I won't repeat what I said earlier, but that's not happening right now. Secondly, in Congress, the word control gets bandied around a lot, and it's the wrong word. You can see this today. There are majorities in Congress, but there's definitely not control. What you're going to get in 2025, I think, is more of the same. The parties, I think, right now are likelier than not to flip, where you get a small Republican majority in the Senate, a very small Democratic majority in the House. But net, what you're going to end up with fiscally and in a lot of other ways is very much the same kind of Congress you've got today that's not going to deal with fiscal issues if people are restive, and will continue to contribute to the kind of half measures that we've seen in American foreign policy at the time where there's the highest geopolitical risk in 50 years.
All right, and one more from me. How much do you trust polling data right now? There's been a lot of skepticism around it, and now that Biden's starting to look a little bit better, do you discount that at all, or do you think we can trust the polls right now?
Well, I never trust it, and I would never suggest anybody trust it. But and I would particularly urge people not to look at national polls for president, because they're not only beauty contest polls, but the president isn't elected in a national popular vote. He's elected in the Electoral College, and it will be a he this year. So. He's elected in the Electoral College, so thus the attention to battlegrounds. Generally speaking, the last time polls were pretty accurate on Biden. They tended to undercount Trump slightly. I would look for pollsters to try to attack that a little bit and correct it. But I'd be looking at battlegrounds almost exclusively were I an investor. And would I trust them? No. Will they give you a sense of sentiment? Sure.
Terry, I want to finish on the former president. You've had some, I think, industry-leading thoughts on the former president, A, topping out, and B, making the point that perhaps he's not the candidate he was in 2016 and 2020. Terry, what do you think is changing?
What I think is changing fundamentally is that 8 years ago, he was seen as a change agent, and people were so frustrated they were willing to take a chance on breaking some china in order to have change happen. And this time out, after 8 years, whatever else he isn't a change agent, number one. Number two, the Trump base, I think, demonstrably isn't getting any bigger, and you can see that from primary election data. And thirdly, frankly, people are getting tired of the act. And beyond that, I think you've got a Republican Party that's more than ready to move past him, no matter whether you're a Trump acolyte or not.
Hey, Terry, great to get your thoughts, buddy, as always. Terry Haynes there of Pangea Policy. We started Q1 by talking about Laurie's quote that talking about the election was like staring at the sun. Is it the same in Q2? Are we moving on a little bit?
Well, there's the eclipse next week, right? So people are going to be forcing themselves to, and that's maybe a good analogy for the market, right? I think, I talk to clients and they don't want to be talking about this, but they're getting questions and having to put out their papers and having to start thinking about investment allocations. And I do frankly worry, the question I asked Terry, I worry about the non-U.S. investor who's been setting up for a red sweep. That seems like a pro-U.S. trade. I saw some headline late last week talking about, interest picking up in Europe. If election dynamics are changing, does it cause some of these non-U.S. investors to pull money out of the U.S. and put them in other markets? That's rotation in the leadership, but is there something else under the surface too?
The struggle for many, I think, is still so early in the year. I think we still need to think about who the VP is going to be potentially for the former president. Politico with this overnight. It's Veep stakes season for Trump. It's not going to end anytime soon. He's going to draw this out apprentice style, which is basically what you said about a month ago.
Absolutely. He's going to want to be the kingmaker. It means that he's going to get a lot more attention, going to get his name ID up, and he's going to float some people and see, to Terry's point, what part of those individuals outside his base potentially flock to his VP.
If you're just joining us, equity futures right now positive 0.4%. Coming up next on the program, China's factory activity beating expectations in March. We'll catch up with Bloomberg's Enda Curran from New York. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Kicking off Q2, equity futures positive by 0.4% on the S&P. On the Nasdaq 100, up by 0.6. There's your outperformance on the small caps. Is it real this time? We'll ask that question a lot through the next 24 hours. We're up 0.7% on the Russell. In the bond market, 2-year, 10-year, 30-year. Things just stabilising on the 2-year, basically ending March where we started it, around 460, 459.72 this morning. Yields a little bit lower by a couple of basis points. But the interesting breakout, I think, in the last 30 days or so, the last 4 weeks, has been in the commodity market. Starting to see copper breakout, see the same in crude again overnight into this morning. Gold, new all-time highs, fresh records for gold, up another 0.9%. Copper up by 0.2%. Brent crude's pulling back just a touch by 0.4%. Energy breaking out. Anne-Marie, we've seen it in energy equities. Energy stocks on the S&P 500 up by something like 10% in the month of March.
I'm just stunned by Brent crude. People are talking about $100 a barrel. Well, we're not that far away. We're above $85 a barrel on Brent. And Jonathan, when I look at a number like that, this has to be a headache for the White House. Do they need to potentially think of a strategic petroleum reserve pulled drawdown, strategic election reserve potentially, if you're looking at $4 or $5 gallon of gasoline this summer? This is the worst timing this administration could potentially have for a breakout in energy prices.
Let's think about what's behind it first before we get into what they can do about it. Is it just a supply-side story? I think the data overnight, we'll talk about it in just a moment. Signs that China's starting to bounce back as well. Just subtle signs that maybe they're starting to rebound.
Absolutely. So on the demand side, potentially you are seeing this pickup in China, but also on the supply side, OPEC has been ratcheting back all of this production. And we're going to get a JMMC meeting, an OPEC ministerial meeting on Wednesday. Potentially they're going to reiterate, we're going to still keep some of that ratchet back some of that production. They want higher prices, some of these countries. Part of that, Jonathan, has to do with the fact that the supply is coming from the United States of America. Record supply coming out of the United States.
Brent crude right now, 86.66, WTI 82.90. Under surveillance this morning, busy week for data and Fed speak as well. We'll hear commentary from the Fed every day this week, including Chairman Powell on Wednesday. ADP employment data also coming that day. Another round of jobless claims on Thursday, followed by the main event, payrolls Friday. Bloomberg survey, the median estimate, 200K for the month of March. Laurie, you're with us for the hour, I'm pleased to say. I want to talk about the data. What's more important to you at the moment? Is it this week's payrolls report or next week's CPI report? Because you get the feeling from the FOMC that maybe things are shifting away from CPI and shifting back towards payrolls.
I would say for me, it's still the inflation data, because I think in my mind, you still need to see progress on inflation in order for the Fed to justify starting those cuts mid-year. I think on the jobs data, you know, we've talked a lot about small caps, right? One of the things we've seen historically is that around when you get the negative inflections in the unemployment rate, i.e. it starts to move up, that tends to be actually pretty close to the inflections in small cap outperformance relative to large caps. And it's sort of the idea that these more cyclical parts of the market bake in pain early, and then once you actually get evidence of it in the labor market data, you sort of go ahead and buy it on the discount, right? That you've already priced in all the bad stuff. So I'm a little bit less concerned about the labor market data. I do think, it's kind of bad news could end up being good news for the Fed call. So I kind of have a hard time, and if we don't get the bad news and inflation cooperates, then, the Fed can still cut, right? Like, I'm not convinced they really want to, bang up the labor market in here just for the sake of doing it.
When it comes to inflation on Friday, Powell said you won't hear us overreacting to these past 2 months when it comes to CPI. But what happens if it is not 2 months? And that CPI next week will potentially give us some insight into if it's stickier.
Right, and I think it's fair. And, we've done a lot of work like looking at historical cycles. And if you go back to the 1940s, we did see inflation ebb and flow, right? So just because you've killed it doesn't mean it's permanently killed. So I do think they're right to be vigilant going forward. And, I think this Fed has just gotten so beaten up for letting inflation getting out of hand. I don't blame them for being cautious on the other side.
The big data point of the week is payrolls on Friday into next week. You'll get CPI and some bank earnings as well. I want to turn to this story. Officials in Baltimore are set to open an alternative temporary channel for shipping near the collapsed Francis Scott Key Bridge. This is part of a phased approach as crews scramble to remove debris and open up as much of the shipping lane as possible. The Department of Transportation announcing $60 million in emergency funds going towards rebuilding the bridge. The Biden administration continuing to call on Congress to fund the rest, which is expected to be in the range of hundreds of millions of dollars. Now, we had Terry Haynes of Pangaea just moments ago, Anne-Marie, talking about the difference between having a majority and having control. Who has control over this issue at the moment?
Well, this issue right now is going to be Biden continuing to remind Congress that they need to act. What I would take note of is what Maryland Governor Wes Moore said over the weekend. He pointed to the fact that this will impact a farmer in Kentucky, an auto dealer in Ohio, and a restaurant owner in Tennessee. He's saying this isn't a Maryland, which is right now a blue state. This isn't a Maryland issue. This is a national issue, because this is what the issue is going to be, Jonathan. And yes, the Republicans technically have control of the House, but they can't really get anything through without Democrats supporting.
Laurie, one question we had last week was whether that event was really a challenge overall to the broader story of goods disinflation, which seems to have taken a little bit of a back step, a step back in the last few months. How much of a challenge is it?
I think we're going to have to see how it plays out, but it's something certainly you want to add to the list of reasons to be vigilant there, right? And I would say when I think back to our economists, they were expecting some bumps in the road, and I think, goods inflation coming up a little bit more than they expected was maybe a little bit of a bigger bump. So I think it's an important issue on this, specific port. I think we're just going to have to see how it plays out. But I do think it sort of brings the whole infrastructure discussion back into focus, and that has interesting, interesting ramifications down the road. I think in terms of how Biden campaigns, are there some potential, at least he's done something on that front? Does it give them something to talk about? And I think we've all assumed on Wall Street, right, whatever we get out in November, Congress isn't going to be able to do much going forward.
Yeah.
Well, maybe there's an interesting sort of area of bipartisan agreement that's starting to emerge, and there's maybe, some stimulus dollars that might come back into the conversation.
It's a good point. Speaking of bumps in the road, major bumps in the road over in China and possible signs of a recovery. Chinese stocks gaining as factory activity beats expectations in March. The Caixin Manufacturing PMI Index rising to 51.1, marking the 5th straight month for expansion and the longest streak in more than 2 years. Troubles remain in the property sector, with home sales dragging for March. The value of new home sales for the 100 biggest real estate companies sliding 46% from a year earlier, according to China Real Estate Information Company. Bloomberg's Enda Karen joined us now to break down some of this data. Enda, let's talk about this. You've got the official manufacturing read. You've got the Caixin manufacturing read. What are the two saying right now, Enda?
They're both headed in the right direction. They're saying the industrial production upswing is looking a bit more firmer in China now, Jonathan. These readings, as you mentioned, both in positive territory above 50, both beating expectations. And when you look into the detail of the two PMI readings, they're suggesting that new export orders are doing well also. So suggesting that there is momentum there behind this export and industrial recovery story. And that gels with the idea that China's exports are also recovering this year. So it is starting to look like the manufacturing and the industrial side of the economy is doing okay. You've mentioned, of course, there's lots of problems elsewhere. I think the big question is going to be whether or not this industrial upswing proves to be sustainable. We kind of had a bit of a false dawn this time last year as well. But right here, right now, for the rest of the world looking back at China, it looks like one positive part of their economy for sure.
And the commodity market is telling very different stories. When you look at copper, when you look at iron ore, copper backs up that rebound in China, other things as well, big supply side story there. What is iron ore telling you when you pick that out of the commodity market right now, given the plunge we've seen over the last few months?
It's a curious proxy, Jonathan, because iron ore used to be the 101 for China's economy, where iron ore was going, China's economy was headed. Last year was a year of doom and gloom for China's economy, but yet iron ore defied all of those expectations, and it was well over $100. This year, of course, the story is meant to be one of China putting more support into the economy. They've set a fairly aggressive growth target of 5% that politically they will want to hit. But as you mentioned, of course, that's not being translated into commodity prices or the iron ore price. I think, broadly speaking, there are concerns around inventories, how much stockpiling there is. But don't stray too far from that 5% target. That's a political target. A lot of economists will tell you that even though it's ambitious, the authorities will spend and needs to be done to hit that, and that will have some flow through to commodity markets inevitably.
And when you're looking at these numbers coming out of China and potentially the demand we're seeing because of what's happening in the commodity sector, is this the resurgence, the coming out of COVID that everyone was waiting for when it comes to Beijing?
It's a good question, Anne-Marie. I think the consumer side of things is still fairly downbeat there. We know that our colleagues in Beijing report about the ongoing sentiment there remaining in the doldrums, so to speak. We know the real estate story has not turned around either. We know that new house prices, housing demand, that is yet to turn a corner. The bright spot is its manufacturing side and the export side, the industrial production side. But let's not forget, that in itself is stoking tensions too, because around the world, plenty of rival trading governments are now looking at China's exports, doing very well, questioning whether or not Chinese products are being dumped into global markets, and of course whether or not that's impacting their own companies and their own production. So China's industrial recovery and an export recovery could in itself end up stoking more political tensions with key trading partners, not least, of course, the US in an election year. So I'd say, yes, this is a bright spot. It looks like the industrial story is picking up, but we still have a long way to go on the real estate and on the consumer recovery in China.
Well, when it comes to the real estate and the property market, what could China do to help finally prop this up? Because obviously this remains one of the biggest drags in the economy.
It really does, and a lot of, again, observers waiting for this big China rebound have been wondering why haven't the authorities taken more concrete steps to get the real estate story going again. And again, it comes back to what can they do to tackle bad debt? What can they do to go in and recapitalize those banks involved in the sector, those property developers involved in the sector, take over that bad debt, recapitalize them, get them going again, get those projects finished again. They have, of course, been taking incremental steps. They've been bringing down borrowing costs, they've been making it easier to get financing, etc. But none of it has really turned the corner. And I think until they really do solve the property story, until that happens, then it's going to remain as a dead weight on the broader consumer story. And a lot of people, as I've said before, when you look at China's economy, they're looking at one sector and one sector only, and that's real estate, and asking when will that turn the corner.
I'm going to look at a different sector now then. Just to be different, Ender, I want to talk about autos. I cannot think of a more competitive sector worldwide in any country, in any market, than the auto sector in China right now. For a while, Tesla has had to flag higher prices. They've increased. This is how the market's responded. Shanghai-based NIO announced a plan today that provides up to 1 billion yuan, that's about $138 million US, of incentives for drivers of gasoline cars to make the switch. Here's another one. Chery Automobile said it will cover the cost of purchase taxes on selected models, plus offer better trade-ins for customers' used cars. That's just China. And some of those manufacturers are going to bring the challenge to the United States. Can you walk us through how the tension is building between policymakers across the world right now, from the United States to Europe to China?
Yeah, I think there's a view that China really stole a march when it came to electrical vehicles, John. I remember speaking to an industrial executive last year, actually, out of China, from a big multinational company, making the point that really and truly it was during the COVID years that the Western world missed a step, and China's really raced ahead on the EV front, and we're seeing those results now. Like you say, in China, foreign automobile companies used to do quite well. They were competitive, huge market space there, but the shift to the EV space is very much to the advantage of China's homegrown companies there. And of course, now in the global market, we're seeing those tensions, not just in the US, but in Europe, worries about cheaper Chinese competitors, subsidized Chinese competitors, and how do governments tackle that? And it's absolutely one of the hot-button political topics, not just in the US, as I say, but also in Europe and elsewhere, how to handle and how to compete with Chinese exports of EVs. And by the way, it's not just EVs. As I mentioned earlier, the industrial production recovery story, the export recovery story, that's about solar panels, that's about key tech components as well. There are lots of areas where Some analysts are now looking at China and going, wait a minute, are they exporting extra capacity? Are they dumping on world markets here? And what will that mean politically? So this is going to remain a key topic, I think, politically in the months ahead.
Without a doubt. Enda, thank you, sir, for the update. Enda Curran there of Bloomberg. Anne-Marie, it's the front line right now, potentially, for a big tariff war later this year.
Absolutely. We just heard from Janet Yellen speak about this. And to Enda's point, it's not just EVs. She was talking about lithium batteries. She was talking about solar panels. The fact that most economies in the West think China's just dumping them on this market. And what does China do? They go to the WTO and they say it's the United States, which the FT this morning, in their opinion, say is very rich, saying it's the United States who's the problem with their Inflation Reduction Act.
Sort of dripping with irony. I don't know if the control room has got pictures of the Xiaomi SU7 electric vehicle on display in Shanghai, but a little bit later in the program, if we can get that picture and compare it to the Model 3 Tesla, they look like exactly the same vehicle. Have you seen these pictures?
Not of the Xiaomi, no.
If I'd seen that and told you that was a Tesla, would you believe me?
Yeah, especially right there when you don't see any branding.
Yeah, it's not one.
It's the color, though. I don't think Tesla does that color.
Amazing. The Xiaomi SU7 just sort of really shaking things up in the Chinese market. More on that a little bit later. Let's give an update on stories elsewhere this morning. Here is your Bloomberg Brief. Here is Yahira Hakez. Hey, Yahira.
Hi, John. For the first time in its 16 years, the Bank of Japan's supply of bonds is set to shrink. The central bank's gross bond purchases are estimated to fall below the amount of maturing debt for the July to September period. The BOJ is speculated to start slowing its buying as soon as this month. It currently holds 54% of all outstanding debt. The expected move likely won't meaningfully reduce the BOJ's stash of bonds, since the central bank is keeping plans in place to offer cheap loans, encouraging banks to purchase debt. A big data breach at AT&T is affecting more than 70 million current and former customers. The telecom company says the data leaked on the dark web and includes personal information such as social security numbers. AT&T says the source of the data is still being investigated, and it's not known whether it came from the company or a vendor. It's not the first issue this year for AT&T. Back in February, it experienced a widespread outage that took hours to resolve and is now being investigated by the federal government. Tesla is increasing the price of its most popular Model Y sport utility vehicle. All three of its Model Y variants are now $1,000 more expensive. The hike was widely telegraphed for several weeks, and China's automakers are piling in to take advantage, offering sweeteners such as subsidies and coupons to attract potential buyers. That's your Bloomberg Brief. John?
Yahira, thank you. Up next on this program, a patient Chair Powell.
Many forecasters see growth coming down to around 2% this year. That's about roughly what the first quarter looks like. That means that we don't need to be in a hurry to cut.
What's the rush on the FOMC? That question up next. Live from New York City, this is Bloomberg.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Live from New York City, equities bouncing back just a little bit to start the quarter, up by 0.4%, adding some weight to the recent equity market rally of more than 10%, double-digit gains for Q1. Single name, let's check in on BYD. BYD unit sales, vehicle sales up 46% year on year. The growth here is just phenomenal, up 56% for plug-in hybrids over at BYD. And AMH, this is where the competition is right now in a major way.
Absolutely, and it's why you see the United States potentially adding more, and they're undergoing potentially not allowing China's vehicles to come in. They'll say part of this is national security, but also is the fact that they want to make sure they can have their own automakers competitive in the United States and China. 25% tariff for a Chinese vehicle to get into the United States. But Jonathan, look at these numbers that's happening in China, and it's why you see all the other automakers having to cut prices just to remain competitive.
Quick snapshot of analyst recommendations on the name: 38 buys, 1 hold, and just 1 sell. Under surveillance this morning, a patient Chair Powell.
The economy is strong. We see very strong growth. We had growth for last year over 3%. Many forecasters see growth coming down to around 2% this year. That's about roughly what the first quarter looks like. That means that we don't need to be in a hurry to cut. It means we can wait and become more confident that, in fact, inflation is coming down to 2% on a sustainable basis.
Here's the latest this morning. Core PCE, the Fed's preferred measure of inflation, cooling in February, reinforcing bets the central bank will cut rates later this year. We'll hear again from Powell on Wednesday, ahead of US payrolls on Friday. Mike McKee, our economics and policy correspondent, joins us around the table. So, Mike, you were in on Friday. You drew the short straw. Yeah. Any big changes on the data going into the weekend?
No big changes on the data. Jay Powell had told us that the core rate would probably come in about 0.3%, and it did a little below that as he forecasted, and then it's rounded up to 3. But basically, what we're seeing is inflation is continuing to come down, but it has slowed its progression, and that's what the Fed is looking at. Powell was asked, "Why don't you, cut anyway?" And he basically said, "We don't want to move the markets around. We don't want a lot of volatility. We want to be safe. We want people to think that we're moving in the right direction at the right time. We're going to be careful." And so he just justified it with the part you just heard about how the economy is strong. They don't need to cut right now.
We were talking to Laurie earlier in the hour about the boom we saw in January, waiting to see if February confirmed that or not. It didn't really. Ian Shepperson of Pantheon Macroeconomics saying the spike in January was a one-off. It was a one-off fluke. Is that how you'd characterize it?
No, at this point, it's, yes, a fluke in terms of that extra added, but we're still seeing strength. We're seeing strength in hiring. It's over 200,000 each month. We're seeing strength in spending. The PCE spending numbers came in up 0.8, which was a sort of phenomenal turnaround from January. So we're seeing the U.S. economy running ahead of potential growth, which is a warning flag for a Fed that's still worried about inflation.
I would say, the question John asked me earlier about employment versus inflation in terms of the stats. What do you think are more important in the next couple weeks?
Inflation, I think, is what the Fed is really looking at. The jobs numbers will add to an impression one way or another of how strong the economy is, but there's going to be a lot of data on that for them to absorb, where the inflation numbers are an actual target. Yeah. That's what they've been looking at. And I think that's what the markets will look at and push in the direction of, depending on how the inflation data goes.
So one thing that's come up repeatedly in the communication of Chairman Powell, which is why I think a lot of people are asking that question that Laurie just mentioned, is there seems to be this emphasis on the labor market, and if it weakens, we'll be ready to respond. What do you make of that shift, if we can indeed call it a shift?
I don't know if it's a shift so much as the Fed, it's an insurance statement. Like, if we are all focused on cutting rates, the market totally focused on cutting rates. If we had a situation where the economy was going into a recession, then we would cut rates much faster. And what he's doing is avoiding using the word recession by talking about the labor market.
Powell on Friday also talked about dividing their critics into now equal-sized parts, basically saying those who think we should cut or those who think we should maybe stay the same or hike. If that's where you are, then wouldn't that show that the Fed is actually at a perfect position?
It should. But, of course, everybody on Wall Street is never satisfied with where the Fed is. It's always the Fed's fault. I never made a bad trade. It's the Fed's fault. And so you do have half the people thinking that the Fed needs to cut, half the people thinking the Fed needs to raise, and you can see that play out on X and the other social medias feeds. And so for the Fed, they do feel kind of like they're in a good position because the economy is strong, but inflation is still going down at this point.
Anne-Marie mentioned the distance between Governor Waller and Chairman Powell perhaps narrowing. What do you make of that? What is the distance between the likes of Governor Waller and maybe President Bostic and the rest of the committee?
Well, I think basically everybody's sort of moving in that direction. The idea that the economy is stronger than they had anticipated is pushing people. We saw with the dot plot that came out in March that a number of people had moved up, and they were not going to be willing to cut. It would only take one more person to change, and you'd have the two dots. So I think if the economy continues along this path, and we have no guarantee it will, that you probably in June would see a dot plot. And then the markets have to recalibrate everything again.
I do wonder, Laurie, just to finish up with you, how different would the conversation have been the other week if we did get the median dot shifting from 3 to 2? Because we were only that far away. We were pretty close to that happening.
Yeah, look, I don't think it would have necessarily been enough to prick this sentiment bubble, our bubblet that we've got there right now, but I think maybe it could have dampened the enthusiasm just a little bit. We have run some numbers, sort of looking at the Fed SEP or even just keeping inflation sticky and no cuts from the Fed. And if we run our valuation model through that stress test, we get to an S&P of like 4950 to 5100. So I don't think it would do, if we just take them all out, I don't think it kills the market, to be honest. But it could, kind of flatten us for a bit.
You mentioned the B word, then backtracked a little bit. Can I just bring up that B word, bubble and bubblet?
Yeah.
What's the difference between the two?
Look, I think when you go back to this Mag 7 conversation, is it irrational exuberance? I started in this business back in 2000. It's not silly like that. I mean, look, these companies had the earnings to back up the premium valuations. Those earnings are decelerating. That earnings growth advantage is decelerating. There's less of a rationality to pay that premium multiple, but this is not a stupid market by any stretch.
This equity market has ripped to start the year. Mike, good to see you. Mike McKee breaking down the economy and Chairman Powell. Laurie, thank you for the last hour. Thank you very much. Laurie Cavacina of RBC Capital Markets. Coming up for the next hour of Bloomberg, we'll catch up with Jay Pawlowski of TPW Advisory. He'll be with us around a table for the next 60 minutes or so. We'll speak to Lee Klasko of Bloomberg Intelligence, Norman Rule of CSIS, and Ed Al-Husseini of Columbia Threadneedle. Norman Rule, got to talk to him about the potential, Anne-Marie, that Israel makes a move into Rafah in the next few weeks.
And potentially get an update on that because Axios is reporting that Israeli officials will be speaking to the Biden administration today. And what we've heard from the White House is that if they go in, it's the way they go in that matters.
That conversation just around the corner. Equity futures right now on the S&P 500, adding to the rally, closing out Q1 at all-time highs and looking to add to it here in Q2. Live from New York City, the second hour of Bloomberg Surveillance. Up next.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet
is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Chair Powell will have some communication challenges ahead.
They have a communication issue right now. They're going to have a tough time navigating this because the markets are really dependent on them being dovish.
It's possible that they start to cut and the economy just reaccelerates a little bit.
Our first rate cuts are probably in September.
We're leaning on June for the first rate cut.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Leaving behind solid gains in Q1, welcome to Q2. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. The second hour begins right now. Alongside Anne-Marie Hordern, I'm Jonathan Farrell, joined together this morning by Jay Pawlowski of TPW Advisory with us through the next 60 minutes or so. If you are starved for Fed speak this week, you are not going to be on a diet, that's for sure. Look at this lineup. Williams, Mester, Daly, tomorrow, Wednesday, Goolsby, Powell, Thursday, Harker, Barkin, Goolsby, Mester, Barkin again on Friday, and a whole lot more. Friday morning, the big one. It's payrolls Friday, the estimate, 200K. Your equity market on the S&P 500. On the first trading day of April, equities look like this. Futures positive by 0.4% after closing out Q1 at all-time highs. In the bond market, your 10-year 420.82. Plenty to talk about this hour. We'll catch up with Lee Klasko of Bloomberg Intelligence as ports on the East Coast scramble to absorb cargo. We'll catch up with Norman Rule of CSIS. With Axios reporting the US and Israel will hold a virtual meeting today, and Ed Al-Husseini of Columbia Threadneedle on why he likes long-end bonds. We begin with our top story, kicking off the second quarter following 5 months of gains on the S&P 500. Jay Pawlowski of TPW Advisory thinks the rally can extend, writing this: we are optimistic not only about 24, but the out years as well, 25, 26. Our analog remains the US 1995 to 1999 period. The difference is, this time, it's global. Jay joins us right now. Jay, good morning to you.
Good morning, John.
Does the economic data in China back some of that up this morning?
It sure does, John. I mean, I think it's clear to us, at least, that, and it's not only the data, right? We wrote a piece on Friday, our Friday Musings, called Listen to Stocks, Not Vox. And we want to pay attention to what the markets are telling us. And it's not just stocks. It's also credit outperforming the ag, and it's commodities. And commodities, I think, right now are the big tell. Commodities, and it's not just energy. It's not just gold. It's not just copper. It's all of it. It's ag. It's all breaking out. And that is telling us that there is an opportunity and that the global economy, as we've been saying since the fall, is early cycle.
Soft commodities as well, seen it in cocoa.
Absolutely.
But a lot of people might say that's a supply-side story, not demand. How would you frame it?
I would frame it as both, and that's perfect. It's both supply side as well as demand side. And the fact is that most people have not been investing in commodities, and the demand has been weak, and they've been okay. And now we're coming into a point where that lack of investment, which can't be made up quickly, is going to bite. At the same time as a global economy, we think is setting up for a considerable period of good economic news. And that combination and the fact that very few people are invested there, very few people understand that commodities are the best performing asset class in the world year to date. Everyone wants to talk Mag 7. Mag 7, Mag 6, Mag 5. Commodities, people, it's really basic. It's supply and demand. You don't have to figure out AI. It's just simply buying the stuff that people still use.
How much does hinge on China, though?
Obviously not very much, because China has been a weak story, and commodities have done well. Markets move first. That's the thing that we have to remember. They're forward-looking discounting mechanisms. They know more than you, me, even you, John.
I'm shocked.
And therefore, they move first. And so commodities are, world's best performing asset class, when now people are just starting to think about China. Okay, PMI is better than expected. JP Morgan last week raised their Q1 GDP estimate to 6.6%. Okay, so you're talking about second biggest economy in the world, looking like it's starting to pick up, and that is obviously bullish for lots of things, including commodities.
A phrase we heard repeatedly, I think, over the last year regarding that region, that part of the world, was uninvestable. And I guess the caveat around that is it depends what you're investing in to get exposure to it. There's a great quote in your recent note, and I'm going to share it with our audience, and I want your thoughts on it. We note the discrepancy between the China tech stack, one that will increasingly have all of China to dominate. That's a really important line. Can you just build that out a little bit more?
Yeah, first off, on that uninvestable line, I also wrote a couple months ago, pro tip, when you hear uninvestable, invest. So that's point A, because it can't get any worse. Can't get any worse than uninvestable. But yeah, I think this point about the tech stack is really, really interesting. There are a lot of things setting up to create a big opportunity. And let's remember that markets have already moved in the U.S., in tech, et cetera. So we want to be looking for the new areas of opportunity. And that's why that multi-year positive framework allows us to go from point A to point B to point C, et cetera. And that's what we've been doing in our model portfolios. The tech stack story, look, we've been trying to freeze China out of the advanced technology. We're doing a pretty good job. They've got the message. They have to build their own. They're now turning around saying, okay, fine, you can't play in our tech space. And therefore, the question is right now, do you want to be invested in a market of 1.4 billion people growing at 6% per annum with an e-commerce market that's double the size of the U.S., 10 times the size of Japan, and trades at a 70% discount? Alibaba trades at 8 times earnings. Tencent trades at 14 times earnings. China overall trades at 9 times earnings. Okay, no one owns it. I think it's a really interesting story. And the segue, flip your Mag 7 into KWEB, which is the China Tech ETF. KWEB can double and double again and still not get to the level it was in 2021, John. 25 to 50. The 2021 high was $101. I mean, that to me is a no-brainer. And we full disclosure, we own it.
Peter Chi of Academy is going to join us later in the program in the next hour. He's put the emphasis on made by China. How important is that phrase going to be in years to come?
Yeah, I mean, I think we're big believers. Our name and our firm, TPW, stands for Tripole the World. Our whole thesis, our framework is regional integration in the 3 main regions of Asia, Europe, and the Americas. All of this stuff is happening kind of as one would expect. Supply chain regionalization, tech stack, independent development. Everyone needs AI. Everyone needs the climate proof. Everyone needs everyone needs electric vehicles and batteries. And these are the things that are driving that regional integration. And look, I think China is in a much stronger position than people give it credit for, because the region that they're in, that they're going to dominate, is ASEAN. ASEAN is the biggest, fastest growing region and will be for the next 10 years.
It's striking that you have such conviction in China when what we continue to hear from Washington is that they're just going to up the ante. Right now, they're weighing whether or not they're going to sanction the chip makers around Huawei's entire production. How much does that concern you?
Yeah, no, there's a race, right? There's a race going on. China's racing to get itself kind of independent, and we're racing to freeze them out of this stuff. And I think the point that we see is that the U.S. trying to freeze China is already in the price. Everybody who doesn't want to invest in China because they're worried about U.S. sanctions is already gone, long gone. And they're not going to come in. Fine. We don't need them to come in. Again, KWEB can double and double again. I'll just take the first double from 26 to 50 and leave the second double to somebody else.
So a 60% tariff wall for Chinese imports doesn't matter?
Yeah, sure, it will matter. Markets will sell off depending on where we go between now and then.
But I mean, if China is going to build within their own ASEAN.
Yeah. I mean, I would look at what China's done over the last 30 or 40 years, and I don't think we'd want to bet against their ability to kind of construct what they need to construct.
So when everyone else said uninvestable, you got bullish. When you say no-brainer, does that make you uncomfortable? What are the risk factors you would acknowledge exist around this bullish thesis?
For China?
Yeah.
Clearly what Anne-Marie said is one. I mean, if we come out, if the former president wins, which as I've said on this show, I believe Biden will win on a landslide. But if the former president were to win and were to implement the tariff structures that he's talked about, that's clearly going to set the Chinese market back. But by the same token, as we advance to that point in time, China's own internal dynamics theoretically should get better, right? The property market should be better dealt with. The focus on domestic consumption should be moving further down the road. So it's not a zero sum. And how that all plays out, you know, I mean, we have the ability to change our mind and to adjust our positions, and so we'll look at that when the time comes. But, I mean, that to me is a big worry because I think everything else is in the price. Alibaba, and no, it doesn't grow as much as it did before, but as the prior guest said, same is happening in the U.S. tech space. Earnings acceleration is coming down. Same as in Alibaba. The other point is that these companies in China are just like the U.S. companies. They're cash-making machines. They are buying back stock. They are paying dividends. And so, you know, 8, 9 times earnings, I think the risk-reward is some of the best in the world because the risk is already in the price and the reward is starting to materialize.
I'm sure this morning you've managed to convert a few non-believers for a tactical trade. What's interesting about your call is not just tactical, it's not 2024, it's 2025, it's 2026. Why has this been extrapolated out? It doesn't sound like this late cycle story from your standpoint. It feels much, much longer term.
Yeah, exactly, John. And, you know, we put out a piece, our 2024 outlook, back in the beginning of November, so 5 months ago. The title was Surprise, Surprise. We had 4 macro surprises: lower inflation sooner than expected, better productivity growth, return to stability, and early cycle. All those are playing out. In particular, the return to stability argument. Look at the VIX. Look at the move. Look at the Fed. With all respect to the lineup of Fed speakers, I pay virtually no attention to that anymore. That is not the story.
We've just had an 8-minute conversation, and that's how long it took to mention the Federal Reserve in your whole thesis.
Yes, and that's exactly right.
Why is that?
Because it doesn't matter. The important thing is that the Fed and markets are in sync after being out of sync, right? 6 rate cuts in December, now, and Fed at 3. Now we're both at 3. And guess what? That happened without a ripple of market unease. And that tells me that's one of the things that tells me that this market is a strong market. And so we have, in our view, we're early cycle. We've made a return to stability. The Fed is our friend now, right? Can cut, as you were talking about, with labor worries. The Fed is our friend. The rest of the world is picking up. And so we look at 2023 to 2027, that body of time as being very much akin to 1995 to 1999, where you had productivity-inspired growth, you had lower inflation, you had good earnings growth. The difference, as you quoted, is that this time it's global, and it's global because of this tripolar world materializing in the fact that everybody has to spend on AI, on climate, on semis, on electric vehicles. And so you're getting, in our view, a much more stable globe because you're not dependent just on the Chinese consumer or on the U.S. You now have 3 centers that are going to be growing independently of each other. And so really the question is, who balances best private and public sector, because you need both, because these are huge, huge investments, right? These are like, you know, game-changing investments. And so who manages that best? And that's one of the reasons why we like Europe. And you and I have been talking about this for years. But Europe has more experience than any region in getting everybody around the same page. One can argue they didn't do it well, and it takes too long. But, you know, look at the U.S. and Congress, right? I mean, no, not really an example of great governance. And look at China stumbling after a really good run. So I look at ASEAN, and China dominates ASEAN, fastest growing region of the world. We want to play there. We look at Europe integrating, being forced by conflict to integrate, right? Multiple countries spending together, raising debt together, so you're going to see that capital market integration. And then we look here in the Americas, and we see Mexico, which again, you know, we've been overweight and invested in for 2 years because it is the flagship for the tripolar world thesis. You know, biggest beneficiary of what's going on in the Americas. We were invested in Poland. You and I talked about that last time for the European thesis as well.
Yeah.
And we're invested in China for the Asian thesis. And so to us, it's an exciting blue sky period ahead. And the fact that most people are not there, people have kind of gotten on to the tactical trade. I mean, you know, 27% in 21 weeks. If you're not on the tactical trade, you're probably not working anymore. But, you know, to us, the good news is that we are, you know, we see the process moving for multiple years, and we're still early in that, and others are going to come behind us. We're already double-weighted commodities, and we have been for 6 months. And so we're, you know, we're just moving from point A to point B and onward.
This is some super bullish stuff. Just remind me never to book you for Fed Decision Day. Okay? Jay Pilowski at TVW is going to be sticking with us through the rest of this hour. Equity futures on the S&P 500 positive by a third of 1%. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Turkish President Recep Tayyip Erdogan suffering a historic beat at the ballot box. The lira weakened in early trading after Erdogan's AK party fell behind the country's main opposition, the Republican People's Party, in municipal elections over the weekend. Support for Erdogan's ruling party is at the lowest on record as the nation battles rampant inflation and the highest borrowing costs since the president swept to power more than 2 decades ago. Salvage specialists are starting the daunting task of clearing debris from the destroyed Francis Scott Key Bridge in Baltimore. Ports along the U.S. East Coast are modifying their operations to absorb cargo diverted from Baltimore Harbor. The fallout is expected to be largely contained as neighboring facilities with spare capacity tweak their schedules. And UPS has announced an expansion of its partnership with the U.S. Postal Service. In a statement, UPS says after an initial transition period, it will become the primary air cargo provider for USPS. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, racing to reopen the Port of Baltimore.
That is the only way to get into most of the Port of Baltimore. And of course, it's important not just to the people and the workers of Baltimore, but to our national supply chains to get that port back up and running as quickly as possible.
That conversation up next, live from New York City this morning. Good morning.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Was going to keep bringing World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Equities doing okay to kick off Q2. Equity futures positive here by a third of 1% on the S&P 500. On a 10-year, just about unchanged, 420.63. Under surveillance this morning, racing to reopen the port of Baltimore.
That is the only way to get into most of the port of Baltimore. And of course, it's important not just to the people and the workers of Baltimore, but to our national supply chains to get that port back up and running as quickly as possible. Then you have the process of getting the bridge back up. That's going to take longer, but that work is already getting underway.
Here's the latest this morning. Baltimore's mayor announcing plans to establish a temporary channel for commercially essential vessels to access the port of Baltimore, as other ports along the East Coast scramble to modify operations and absorb cargo diverted from the city following the collapse of the Francis Scott Key Bridge. Joining us now to discuss is Lee Klasko, the senior logistics analyst for Bloomberg Intelligence. Lee, can you talk to us about how easy it is just to redistribute some of that cargo that was meant for that port and to take it elsewhere?
Yeah, the good news is that the Port of Baltimore it's a large port, obviously, but it's not one of the largest ones in the United States. It's a big player in export coal, and some of that coal could go to the Port of Norfolk. And then it does a lot of business with what's called roll-on and roll-off, so think automobiles, ag equipment, construction equipment. It's specifically stronger in the ag and construction machinery equipment. So that stuff will probably have to move to Philly or maybe New Jersey or Norfolk as well. So you're going to see those types of products be moved. And on an intermodal basis or containers coming in, it's really not a major container port. It is one of the, maybe I think it's number 11 or 10. Obviously, it is big, but that can get easily absorbed in the Port of New York or Philly or somewhere else. And again, this is going to be a short-term kind of disturbance until the channel is clear. It's really unknown how long that's going to take. We've seen estimates between 6 and 12 weeks. I'm a little bit of a pessimist, so it's maybe north of 12 weeks for that to happen. And once that happens, freight's going to return, and the impact's going to be felt on supply chains, but it's not going to be a major blow like we were dealing with during the pandemic, or even what's going on. It's going to be less of an impact of what we're seeing from the Suez Canal and the Red Sea crisis that's going on with the Houthi rebels.
This temporary alternative channel on the northeast side of the main channel that we're hearing from the captain of the port, and this is what they want to try to establish, they talk about that this will be for commercially essential vessels. What does that mean exactly? What is deemed essential?
It's something that's a fantastic question. I don't know the answer to that. I would imagine it is products such as healthcare products and things that we need, not things that we want. But I don't know how they would find those needles in the haystack of a container ship carrying 8,000 TEU. So it might be very hard for them to do that. I think what they're going to do is just try to find some priority for some freight that needs to get in and out of the port more on an expedited basis. But I think it remains to be seen about what that actually means or entails.
Hey, Lee, Jay Pulaski here. How much do you think the focus on getting the port up and running plays off of the ability of Pennsylvania, I believe, and Governor Shapiro to reopen 95 in such a quick period of time? It seems to me like U.S. government officials are much more focused on being able to use these crises as demonstrations of ability to get things done rather than huge problems that are going to take forever to fix. Is that your sense as well?
Yeah, I mean, listen, in a time when we can ever get things done is a great thing. Unfortunately, this is a reaction rather than something being proactive. You know, the highway that stretched along the Francis Scott Bridge had something like 33,000 cars or vehicles on it every day. It's kind of small relative to I-95 or the BW Parkway. Those highways are going to see more traffic. It's not going to really impact that much truck traffic per se in terms of those trucks having to go to different routes, because at the end of the day, the port's going to be closed for a while. So you know, the impact on those on highways is probably not going to be that meaningful. It's obviously going to impact the people that use the bridge every day more so than, call it, truck traffic.
Lee, we're catching up with you more and more. The conversation started in the last few months about Houthi rebels attaching commercial shipping vessels in the Red Sea. Then the conversation shifted to the water levels in the Panama Canal. Where are freight rates? Because freight rates started to pick up, and there was a sense, and we talked about it, that maybe that was temporary. Has it been temporary?
Yeah, so our big thesis has been that, you know, these dislocations are short-term in nature, and a lot of them are, you know, create really knee-jerk reactions to rates. So, you know, Trans-Pacific rates are down about 50% from last year. Transatlantic rates are up around 100% from last year. The transatlantic rates were just really off of weak levels. You know, what we're seeing on the Trans-Pacific side, you know, they peaked, you know, back during the pandemic, and it's been a slow reversion to the mean. The reality is supply-demand dynamics are not favorable to shipping rates. There's a lot of supply coming onto the market. The order book is very large relative to demand. And so, you know, we should see continued deflationary pressures as it relates to the liner rates. Now, when you're looking at the truckload rates, you know, this is a totally different market. But, you know, spot rates right now are very depressed, and they're pretty much poised to kind of rebound, but, you know, we're still bouncing along the bottom. We expect spot rates to kind of start inching up higher with a little more meaningful direction sometime here in the second quarter. And so that should be good for trucking companies like the Warners, Knight-Swifts, and Schneiders of the world.
Lee, this was awesome. Good to touch base with you. Lee Klasko there of Bloomberg Intelligence. We reflected on this last week. Is everything just super fragile, or do bad things just keep happening more often?
Well, it feels like things are fragile and bad things are happening at a short period of time. What I find interesting is that a lot of these ports had peak capacity during COVID, and they started to lessen that back, so they can absorb some of these shocks we're seeing like we are in Baltimore.
Coming up on this program, we'll continue some of this conversation. Axios reporting the US and Israel will meet virtually today as Prime Minister Benjamin Netanyahu vows to press on in Rafah. Norman Rule, the former senior US intelligence official, joins us next. Live from New York City, this is Bloomberg.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and where the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
So Q1, double-digit gains on the S&P 500, more than 10%. Let's just say that was largely unexpected. Q2, kicking off things this morning, equity futures positive, 0.25% on the S&P, up 1/3% on the NASDAQ. The NASDAQ 100 in March did basically nothing. I don't think enough is talked about that. And Jay Pawlowski, you've mentioned it, the action happening elsewhere, energy, the banks, not on the NASDAQ 100.
Yep, absolutely right, John. And I think it's the way the market is moving, right? People are looking for opportunities, and things get exploited so quickly these days, right? It's like, boom, everybody gloms onto something, and it pops. Like, I mean, it was tech, right? In our global multi-asset model, the things that worked over the last month or so, it's copper and it's energy. Our copper miners are up almost 20%. Copper. Right? So it's that type of marketplace where things go from point A to point B.
I'll do something I don't normally do. I'm just going to skip the bonds board and go straight to the commodities board. And we can look at copper, crude, and gold. So copper right now is right through 8K, very close to 9. I want to talk about gold. What do you think is happening with gold as we look at another all-time high this morning and gold is up by 0.9%? What's underpinning that? What's happening there?
Yeah, no, definitely gold is breaking out, and it's just a symbol that multiple parts of the commodity complex are breaking out at the same time, suggesting it's a really strong move. People are under-allocated. You have supply-demand issues taking place. And I think for gold in particular, what's interesting is that the biggest buyers of gold, John, are other central banks. Okay, so this is another example, I think, of the U.S. kind of sanctions policy maybe shooting itself in the foot a little bit. You already see a little bit of dollar erosion, and that's a longer-term story. People want to be reserves in other things. You see every day talk about taking Russian assets and using them to rebuild Ukraine. Maybe a good policy move, but it makes other central banks and reserve managers think about how much do they want to have exposed there.
You said the Fed story wasn't particularly relevant, or rather, wasn't relevant at all to your equity market call. How relevant is it to this? Because there is a sense in some quarters. We had Mohammed Al-Erin around the table with us following the Fed decision, and Mohammed was talking about maybe this Fed accepting a higher inflation rate, going beyond just a 2.0. Do you think that's starting to be baked into the commodity price as well?
Well, I think for gold, it's really rates, right? And so the fact that we've got the peak, we're likely to have rate cuts, that opens the door for gold to start to move. One of the things that we're waiting to see is for the dollar to roll over, and then that gives commodities another leg and gives other parts of the world, like emerging markets, which we like a lot, an opportunity to start to move as well. So that's the second part of the story. Gold is moving first, partly because of central bank ownership, partly because we are giving rate cuts. The rate cut cycle that we anticipate this year, John, will be the most synchronized since 2008. 10 of the 11 major central banks in the world are going to cut. The Swiss National Bank just started the G10 last week. So that door opens, that gold is an opportunity to move higher.
Guessing that one of the 11 is the BOJ.
Yes,
right?
yeah.
which will maybe hike rates later this year, perhaps. That currency pair, dollar-yen, looking earlier this morning, has done virtually nothing all morning. Gold right now on my screen, positive by about 0.9%. Under surveillance this morning, no shortage of Fed speak this week. Fed officials currently slated to speak at a total of 19 events. The headline will be comments from Chairman Powell on Wednesday after he reiterated that the central bank isn't in any rush to cut rates anytime soon. On the data front, plenty of insight into the labour market this week. JOLTS and ADP reports coming ahead of payrolls on Friday. The Fed speak, AMH, you're going to hear from Williams, Mester, Daly, Goolsby, Powell, Harker, Barkin, Goolsby, Mester again. The list goes on and on and on through the week.
Yeah, and how much does it matter given the fact that we already heard from Powell after PCE, and we're going to hear from before jobs? I wish actually he was speaking Friday yet again after the jobs report, because that's really what the market is going to be building up to this entire week. And our survey is expecting 200,000. And then, of course, next week, inflation, which Lori Calvasino says really that's more important.
I'm not even going to ask Jay what he thinks about the Federal Reserve. I'll just go to the next story. Tesla shares higher this morning after the company revealed price hikes on Model Y cars. All three of its Model Y variants are now $1,000 more expensive. The company's website displayed the higher prices for the model in both the United States and China, with moves in China particularly significant as it runs counter to a number of incentives and price cuts EV makers in the country are offering. This was flagged before. I imagine, Jay, it was to encourage people to buy it ahead of the price increase. The competition here, though, is fierce. I shared some of this a little bit earlier. I think it's worth going over again. NIO's come out and announced a plan today that provides for up to $138 million of incentives for drivers of gasoline cars to make a switch. Another Chinese automobile company, Chery Automobile, came out and said it will cover the cost of purchase taxes on selected models, plus offered better trade-ins for customers' used cars as well. Can you think of a more competitive market right now than the Chinese auto market?
Well, what I love about that, John, is that they're communists. How does that even work? Communists are the best capitalists there are in China EV. It really is interesting. And to us, we named Tesla one of the first tripolar world companies a couple of years ago when they had production in Shanghai, production in Europe, production obviously here in the Americas. Now you see BYD doing the same thing, right? Production obviously in China, setting up a plant in Hungary, want to set up a plant in Mexico. And so this is the way the world is working. And Tesla BYD is really an interesting fight to see who is going to work, who's going to be successful. And Emery, to your point about, we were discussing earlier about China and China's ability to kind of compete in a block, you know, BYD is like the leading edge, right? So if BYD is doing fine in China against Tesla. In their competition, John, they are pricing at the same as an ICE car. So electric and ICE, same price. That's going to be a killer for basically the rest of the automakers around the world.
Look at the numbers this morning. They're doing more than just fine, and not just on EVs. To John, to your point, this hybrid push that actually a lot of people are looking at. When it comes to Tesla, though, this price hike, yes, it was flagged, but also it comes as they earlier this month told employees they're not going to produce as many. Remember, they went from a 6.5-day work week to a 5-day work week. Less cars, they have to pay for it somehow. Jack up some of the price.
Jay, you've pointed to a story that I think, though, is going to be incredibly complex in years to come. The difficulty of dominating three of those markets simultaneously. How hard is that going to be? Because we get the sense now that governments are basically determined not to allow BYD to succeed domestically. This isn't a push that's coming from manufacturers. If you speak to the car companies, at least this is what they say on the record, so you decide whether it's what they truly mean behind closed doors as well. On the record, they're willing to compete. What you hear from government officials is they're not going to let BYD compete in places like the United States. So when you think of your tripolar world, are there companies that can be successful across three different regions simultaneously?
Yeah, that's going to be the challenge, and I think the best companies are going to be those companies that are able to do that. And BYD is a great example. So they are already thinking that maybe they're not going to be able to put a plant in the United States. So they've licensed their battery technology to Ford. So they are participating through Ford. They hope to be able to put a plant in Mexico and export into the United States. And I think the challenge is going to be the driver is the climate. And we need to deal with climate, and we need to hit our numbers on the climate. The Chinese have dominated the renewable product line, whether it's solar, whether it's wind, whether it's EV, whether it's battery. And so how do you square that? You know, we need to do this many EVs in order to hit our carbon neutral targets. The best, cheapest EVs are Chinese, and therefore what do we do? I think that is a policy question, but to us, the reality is that the world is moving in this tripolar process, and these companies are the ones who are really leading the charge.
One to watch. It's a big story this year, that's for sure. Let's turn to our next story. The US and Israel set to meet virtually today to discuss the Biden administration's alternative proposals to an invasion of Rafah, according to reporting from Axios. The meeting following comments from Israeli Prime Minister Benjamin Netanyahu saying they're preparing to move more than 1 million Palestinian civilians out of Rafah before launching an attack on the southern Gaza city. Joining us now to discuss is Norman Rule, Senior Advisor on the Transnational Threats Project at CSIS and a former senior US intelligence official. Norman, can you talk to us about alternatives? This conversation is an important one. What do you suspect the alternatives are?
Good morning. Well, first, the nature of the talks themselves tell you something about the alternatives. These are not direct military-to-military conversations. This is an interagency team led by the National Security Advisor, so this is not tactical operations. Second, as you look at the Rafah target itself from the Israeli perspective, they don't need to work in the tent areas. They need to focus on the inner city where the tunnels are located and Hamas leadership in the remaining 4 battalions are located. So the question becomes, how do you move portions of the population to open up areas of the city, likely in a staged progression, to allow Israeli forces to come in and achieve that mission? The challenge, of course, is that Hamas's primary defense is to fight from behind civilians because civilian casualties produce international political pressure that restrains Israel.
Is this meeting today is not tactical? Is it just political? And in that sense, has the pressure the Biden administration has been putting on Netanyahu, has any of it worked and materialized?
Well, the political pressure placed by the Biden administration and its partners on Israel certainly is genuine, but it is meant to ensure that the Israeli operation, which the U.S. supports in theory, is conducted in a manner that does produce the fewest civilian hostages. That will be very challenging. So the U.S. challenges itself how to be involved in this process enough to save lives, but not so deeply involved that it's part of an operation that inevitably will involve casualties, if only because Hamas propaganda will claim same.
Well, Norm, how serious should the Israelis be taking this political pressure from the United States when over the weekend the Washington Post reported that they quietly signed off on another round of warplanes and bombs headed to Jerusalem and Tel Aviv?
The weaponry provided to Israel was primarily consisted of dumb explosives. They're high intensity, but are critical to bringing down tunnels. And if married with precision technology, can be used in a way to minimize civilian casualties. Israel needs this. The Biden administration can slow these deliveries. And Israel also needs this to work against Iranian operations in Syria and Lebanese Hezbollah. So it is unlikely the U.S. is going to cut aid, but the U.S. can constrain that aid, which shapes Israel's operational capabilities.
If we're looking at future aid, though, going to Israel and potentially some of these constraints, do you think this administration would sign off on what some progressives in their own party want, which is strings attached to some of those weapons going to Israel?
It's unlikely only because of the complexity of that statement. For example, if the strings attached are that Israel withdraws from Gaza, then we have to recognize that Hamas not only wins, will take charge of Gaza, will push out the Palestinian Authority, and that leaves, again, a Hamas state in Gaza, possibly within the West Bank itself, on the border of Jordan, which is a somewhat fragile state. So the United States has a complex geopolitical dynamic in which it must engage, but its concerns over civilian losses are genuine.
The president appears to have set a red line. I say appears because he still has the luxury of backing away from that if he wants to. Norman, what do you think the consequences actually are if Israel crosses that perceived red line? What are they? What does the US do? What kind of change in policy would it generate?
I think the idea of a red line is difficult to understand because the U.S. does support operations against Hamas, does support Israel eradicating Hamas. It's just how that's done. So as long as Israel doesn't conduct an operation that results in massive civilian casualties, that appears to be consistent with U.S. policy. If Israel does cross that line, I think you would see a large pause in aid. We saw in 1991 a significant dispute between the Bush administration and the Israeli government over a $10 billion aid package, and that aid was withheld at the time until the then Israeli government made concessions. I think you might see something like that in the future. In any case, the U.S.-Israeli relationship has been really challenged and even stained by this event, and will take some time to recover.
Certainly strained over the last few weeks, even more so. Norman, wonderful to get your perspective, as always, on this story. Norman Rule there of CSIS. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. OpenAI is expanding its global footprint. The artificial intelligence pioneer is set to open an office in Tokyo, according to sources. It will be the company's first location in Asia and third international office overall after opening branches in London and Dublin last year. The ChatGPT maker has been in talks to raise funding at a valuation of at least $100 billion. A big data breach at AT&T is affecting more than 70 million current and former customers. The telecom company says the data leaked on the dark web and includes personal information such as social security numbers. AT&T says the source of the data is still being investigated, and it's not known whether it came from the company or a vendor. It's not the first issue this year for AT&T. Back in February, it experienced a widespread outage that took hours to resolve and is now being investigated by the federal government. In the March Madness tournament, the North Carolina State men's team continuing their shocking run with a win over Duke Sunday night. The 76-64 victory has the 11th-seeded Wolfpack back in the Final Four for the first time since it won the national championship back in 1983. And in the women's tournament, college superstars Caitlin Clark of Iowa and Angel Reese of LSU facing off tonight in a rematch of last year's national championship game. That's your Bloomberg Brief. John?
Yahara, thank you. This is where the man from Duke says he doesn't care about basketball. Is that right?
More than I do about the Fed, John. Definitely a disappointing outcome, but I'm really focused on Duke football. So
of course,
best of luck to the Hoopsters, but
I knew that.
We're football focused here.
I have to do this every year just for my own evaluation, given where my manager went to school. Boiler up. I think we do that every single year. Boiler up. Final Four. Final Four. I was messaging Rachel yesterday. I was like, semi-finals. She was like, no, it's called the Final Four. It's not the semi-finals. So I'm adjusting. Up next on the program, Chair Powell sticking to script.
Growth is strong right now. The labor market is strong right now. And inflation has been coming down. We can and we will be careful about this decision because we can be.
That conversation up next. Jay's going to find a way to weigh in on the Fed Speak. Live from New York, this is Bloomberg.
Names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Equities on the S&P, silence around the table. Futures positive, third of 1%. So excited about sport and baseball and Massachusetts, apparently. Equity futures on the S&P right now, positive a third of 1%. Yield just about unchanged. 420.82. Under surveillance this morning, for some of us at least. Chairman Powell, sticking to script.
We don't see it as likely to be appropriate that we would begin to reduce interest rates until the committee is confident that inflation is moving down to 2% on a sustained basis. But if that doesn't happen, then obviously our rate policy will be different. We can hold rates where they are for longer. Growth is strong right now. The labor market is strong right now. And inflation has been coming down. We can and we will be careful about this decision because we can be.
Here's the latest this morning. Friday's inflation data coming in line with the Fed's expectations, keeping the central bank on track to start cutting interest rates in June. Ed Al-Husseini of Columbia Threadneedle writing this: I suspect we are underpricing how much easing is likely to be necessary in 2025 to offset the normalization this year. But I'd like to see front-end yields overshoot more to the upside. I like owning long-end bonds with this backdrop. Ed, I'm pleased to say, is with us around the table. Ed, good morning to you. Before we get into the yield curve, there's another quote I want to use of yours, and it's on the framing of the Federal Reserve's policy. I think this is really, really important. It's a framework question. Here's the quote. As the Fed moved from looking for real rate settings consistent with inflation declining towards 2% to making rate normalization contingent on signs of economic deterioration, how would you answer your own question?
Yeah, not yet. I think the focus remains firmly on inflation, and the judgment, and we saw Chairman Powell reiterate that last week, is that monetary policy settings are in a good place. Once we start focusing on unemployment and the lack of an increase in unemployment, the bar for starting those rate cuts starts to go up significantly higher, and we're not quite there yet.
Labour market on Friday, payroll's just around the corner, CPI next week. Given what you've just said, is CPI still the bigger number versus payrolls on Friday?
Most definitely. Most definitely.
And it's going to be for the time being, for the next few months, next quarter?
I think that's right. And this is the struggle the Fed's having at the moment, is they're so focused on short-term data, and disproportionately at the moment it's short-term inflation data. It highlights a couple of things. One, there isn't really a great framework for forecasting inflation in this environment. We're feeling our way out in the dark, and that's what the Fed's reiterated a number of times for us. Second, are real rates in the right place? And this is kind of the core question. Are monetary policy settings okay, or are they being eroded by the fact that markets are doing really well and financial conditions have eased? They're shying away from that later question and really just myopically focusing on short-term inflation data.
Ed, I got two questions for you. One, if you look at the Fed funds rate versus the core PCE, one could argue that monetary policy is super tight. Tightest since 07. We know what happened at that point in time. I'd love your thoughts there. And then the second question, at our firm, we're bullish on commodities. And I know you like the long end of the curve. Do you have a commodity view built into that? Like if commodities go up 10 or 15%, broadly speaking, does that make your long end buy recommendation less attractive?
Yeah, let me work backwards. I think commodity space is really interesting at the moment, largely because growth has surprised to the upside so consistently over the course of the past year and a half, right? I don't remember the last time we had negative growth surprises. I think it was 2022, maybe perhaps the middle of 2022, when surprises were negative. And if you look at just the span of the last 6 months, growth expectations for the U.S. have doubled, right? I think the Bloomberg survey has gone up from below 1 to in excess of 2%. This is a fantastic backdrop for the commodity space, and a lot of this recovery has been led globally by manufacturing stabilizing and now potentially accelerating, and we saw that with PMI data coming out of China over the weekend. So a pretty decent backdrop for commodities. I think where it starts to disconnect a little bit from the Fed strategies, that those commodity prices really have not fed into underlying inflation in a meaningful way, right? Oil prices are back up to close to 12-month highs at the moment, and yet inflation has continued to systematically decline. We're now in sort of the 2.5–3% space, so we're squeezing out that last bit. So I think fantastic space for commodities. Remind me of your first question.
Yeah, just the spread between Fed funds and core PCE, real money, very tight, or real rates.
The question is, what's the benchmark for that, right? And this is where we get into the sort of the neutral rate conversation for the Fed. What's the rate that the economy can sustain? And it clearly looks like that rate's drifted higher, at least relative to where we were pre-COVID.
So that raises questions about the limits of potential easing further down the road. You mentioned that in 2025. We heard from Andrew Balls at PIMCO in the FT last week, and he likes duration also, but maybe looking at the longer end abroad, outside the United States. Two reasons: one, supply, another one was the limits of easing here relative to what you might get from elsewhere, the ECB, etc. How would you think about that, the US versus what's happening abroad?
Yeah, I would say, I mean, the key differentiator here is really the domestic growth story here in the U.S. We're large, relatively closed economy. We've not been impacted to the same extent by, let's say, the energy price shock in 22, and the strength of the dollar is disproportionately negative for those economies, and that we've seen that in the manufacturing story in Europe. Where I think it gets more interesting is the judgment call of whether we can continue to surprise growth to the upside, right? This gets into the productivity story. Has something in the economy reshuffled in such a way that we can grow faster post-COVID? My bet is fundamentally not likely, and therefore some of the growth that we've brought forward in the course of the last couple of years is likely to leak out of the system and give us room to cut. And I think duration here in the U.S., again, in part because the starting real rate's a little bit more attractive.
Jay, do you take the other side of that?
No, I like that because I think that extends the story, right? We talked earlier, we have a view that the 2023 to 2027 period is akin to the 95 to 99 period in the U.S., where we have several years of solid economic activity ahead of us. And what I'm hearing you say is that we're set up such that rates can be cut in 2025. And I think that backdrop just kind of reinforces a pretty positive outlook, John, and probably reinforces the non-U.S. play, because that should lead to dollar weakness. I guess that would be my next question for you. You know, what's the view of the dollar here, given your expectations? Because our view is that that's going to be the second leg for the commodity kick, the second leg for EM, et cetera.
Meaningful dollar weakness, in my mind, really begins with an aggressive rate easing cycle, right? Some of the mid-cycle adjustments that we're currently pricing for this year anyway, let's call it 2 cuts or so, probably not going to do it. We're going to need to do a little bit more. The outlier event that tends to backstop the dollar is a risk-off environment, right? That is very, very difficult to predict. You know, risk asset valuations right now are a little bit on the rich side. Yeah, what knocks that off course? I have no idea, right? We might have to wait for that a little longer.
Ed, this was super thoughtful stuff. It's good to catch up with you.
Thank you,
sir.
Thanks for
Ed Ahusani there of Columbia Threadneedle, together with Jay Pawlowski, TPW. Jay, thank you, buddy, for the last hour. Enjoyed this.
Always a pleasure.
Got to keep doing
Thank
this
you. Yeah.
every single month.
Love it.
Equity futures right now on the S&P 500 positive 0.25%. In the next hour on Bloomberg Surveillance, Peter Chair of Academy, former New York Fed President Bill Dudley, Greg Dacko of EY, and former Fed Vice Chair Randy Quiles. A whole lot more still to come in the third hour of Bloomberg Surveillance. Up next.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly, we want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, you know, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, you know, who has been leading some of that research on the impact of lifestyle and dementia. And, you know, this is a promising area.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level up your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
Into AI has been driving the market, but for the last week, all of a sudden, the Russell 2000 is a little bit better. I've liked the energy sector in particular, and I'm wondering now, people are starting to say maybe banking's okay, commercial real estate, biotech side has ups and downs, so we could see a rotation. Unfortunately, I think this time, unlike November where we saw the rotation with strong gains for both, this time I think we might get tepid gains in the Russell 2000 and a small pullback in the NASDAQ 100.
Yeah, your words, and I think they're interesting, they're important, powerful words. Is the rotation more about losing less or making more. Which one is it?
I think it's going to be about losing less right now. I think where a lot of the froth is, where things are overextended, is really in that NASDAQ 100 type stocks. And if you look at it, it's really unchanged in about a month, month and a half. So it keeps coming up, and maybe it's a new high, but barely, unlike maybe the S&P. So I think there's room for that to kind of topple a little bit as people question, have we overextended on AI? Listen, AI is going to drive the future. The questions to me are you getting enough value at today's technology level, at today's pricing? And I'm not sure everyone's getting that. So if you see a pullback there, it's going to be the Russell 2000. Plus, people are looking where to put money that's not at all-time highs or really high PE ratios.
I'll ask a question to you that I asked to Lori Calvasino, who is seeing potentially the signs as well of a rotation. We've had so many rotationary false starts. What makes you have the conviction that you think this could be it?
Well, again, I think we go back to the fall. We had a 22% rise in the Russell 2000 versus an 11 in NASDAQ 100. So that's, a 10% outperformance. That's the sort of thing I'm looking at. I think people are getting tired with the same story. Okay, I've already fully committed to AI. Where am I going to put my new money? And you start looking for value. You start putting money elsewhere. You've seen energy do very well. Mining's doing well. So I think that starts leading the way. If banks can stabilize and we get bank earnings next week, the regionals do well, that really pushes nicely there. And that's what I think drives it.
Jay Pulaski was also talking about energy. You like mining. He also liked soft commodities like agriculture. So you're just seeing the entire commodity landscape push higher?
I'm more in the hard commodities. I think, for me, energy's been really the big focus because how I've been looking at it is it feels like we're finally understanding if we want sustainable energy, we have to build up sustainable energy more rapidly, so that's going to require a lot of commodities. But we also, for the first time, I think, understand we need real traditional energy for the next 20, 30 years, so that's going to be built out. So that's why I think that hard commodity energy is better. I'm not as sure about the ag stuff, though I would not touch cocoa, for example.
Are you doing this through equity exposure or directly through the commodity market? Which one?
I prefer the equities, I think. Again, our story for the last 2 to 3 years has really been that the energy companies of the future are the energy companies of today. People kind of tossed them out the window a few years ago saying, oh, it's all going to be about wind farms. It's all going to be about this. And people are realizing the traditional energy companies have the resources to provide energy today, but the skills to figure out how to provide energy in the future. I think that's where the big bet is still.
Started to see that in March, started to see energy pick up, I think, by about 10%. Really solid month of gains for energy stocks on the S&P, likewise on the banks as well. You've got an interesting take on the Federal Reserve. We've heard echoes of this over the last week following Chairman Powell. While they haven't officially changed their target, they seem to be willing to ease monetary policy even while inflation remains closer to 3% than 2%. What is 100 basis points between friends? What does it change in this market?
So I don't think it changes that much. I think, again, we saw the market priced out. I think we started the year at 6 rate cuts. We went down to as low as 2.5. And the market did fine because it's all about growth. So I think we can manage around that. But I think there is a little bit of froth, and maybe it's deserved, as you see Powell kind of shift his narrative to things that allow him to cut, right? No one's talking about the market doing the work for him. Remember back in November when yields were high? Now the market's undone all the work for him, and no one wants to talk about that. So it feels to me they're constantly looking to pivot to some excuse to be easy, which I understand. If you're the person in charge of the Fed, you probably don't want to be the one who drives us into recession, so you're probably slightly biased easy, and now he's figured out a new rationale for that.
Do you think the Fed is actually working against the market, or rather the market's working against the Fed? Because the Fed seems comfortable with stocks at all-time highs and credit spreads that are super tight.
I think we're okay-ish right now. I think there's kind of a decent balance, right? No one's going crazy. We're not talking about 4 or 5 cuts this year. I think we are rightfully saying it's probably the end of the hiking cycle. Though, having said that, right, as some of this data comes through, and if I'm right on some of the commodities, we might see a bit of a resurgence. And the other topic that's coming up a lot is, as we're saying, oh, inflation's coming down, I think people are questioning, did we ever really manage to monitor inflation for the last 3 years? Are we heavily understating? Because you go into the stores and it doesn't look like things are up 3 or 4% per annum. It looks like they're up 10% per annum. So I think people are questioning some of the actual starting level from this decline.
If the Fed is trying to find any excuse, to your point, potentially to cut, what could they use, say, in June? Say they really want to cut in June, but inflation is still on this path where it's not exactly where they want to be, like the end of last year, but it is moderating. Is that enough?
I think it could be enough because I think, one, they'll just say, listen, it's long lag times and we've got to get a little bit ahead of this. And I think behind the scenes, if they can avoid cutting in September, November, right into the meat of the election, they'd prefer to do that. So I think you're much better off. If you want to get 2 cuts done early this year, you do it June, July, let the markets kind of adapt with that, and then the next one maybe comes in December if we're still there.
John asked a question earlier to a lot of our guests. What's more important, the payrolls number on Friday or inflation next week?
I think it's ultimately the payrolls. I think the market's been driven much more by the growth in the economy, and really it's about the spending on AI. Are companies benefiting from AI? Are the AI companies growing as a competitor? And so
But
we've
for
had
the Fed?
I think for the Fed, it's probably going to be the jobs number. I think they have to look at that. But even then, I think they're in the mode that they're going to close their eyes and say, you know, it's all good enough. We can cut once or twice.
It's funny you say that because that was my sense of things as well, asking the question. That's not the answer I got. The answer I got still repeatedly was that CPI was important. Ed Hosseini of Columbia Trade Needle was with us just moments ago, and he was talking up CPI being more important than payrolls for the next several months, maybe even the next few quarters. What I'm hearing from Chairman Powell is that he could be willing to move earlier if you see something happen with the labor market and deterioration. What do you make of that, just in terms of the shift in emphasis, if we can indeed call it a shift?
You know, one of our theories coming into this year had been that in 2023, he was happy to cause a recession. I don't think it was his first choice, but if you got a recession, that's fine. There is no way he wants to create a recession in election year because that almost hands the incumbent a loss. So I think he is going to be much more cautious about creating a recessionary, and that's where I think the balance is tipped this year too. It's much more about jobs and far less about inflation.
You introduced politics. You think he's worried about the incumbent losing?
I think he wants to be as independent of causing an election result as he possibly can.
Okay.
And so keeping the economy on a steady flow and not turning into recession is probably better for him.
Thinking about politics so he doesn't have to think about politics?
Kind of.
Okay.
Well, your timeline basically says they need to move so they don't look like they care about politics. But the fact that they would be moving so they don't look like they care about politics, they do care about politics.
You know, it's probably pretty hard when, one, you've got Elizabeth Warren writing letters, your boss is the president, and then you've got the former president who is very, you know, active on social media and happy to point out any problems. So get this out of the way, bear the pain, and hopefully, fingers crossed, have to do nothing September, November, and let politics take care of itself.
So a big part of this conversation where we started it was the big rotation and whether it was about making more or losing less. And you said potentially it's about losing less, which should prompt the next question. What part of the market right now, which part of the market do you think is most vulnerable? Because the way we're set up right now, in commodity markets, we've got things that are at multi-year highs. We've got gold that's at an all-time high. In credit, high-yield spreads are at multi-year tights. Equities at record highs. What do you think is vulnerable at the moment? Where are the losses going to be?
So I think it's going to come really from the outperformers. So I think the NASDAQ 100 is the most susceptible. You're going to have some of the individual stocks where now, you know, on individual stocks, they trade leverage ETFs, which seems insane to me, why we would have a single stock leverage ETF, yet it's there. I think it's over $2 billion in market cap. So people are trading this.
It's there because people want it.
Yeah, and it seems a bit like meme stock type stuff. So I think your meme stock, however you pronounce it, but I think those things start pulling back a little bit. The overall market can do well. I think credit's fine. I think credit's very good. I do think, separate from everything else, people should be allocating more to whether it's credit in terms of munis, agency debt, corporate debt, than treasuries. I think if you're running a big bond portfolio, I like the extra spread that you're getting, and you have technically better governance at these entities than now you do out of DC.
Interesting. Pete, you're going to stick with us. That raises a question about treasuries. We'll hit a little bit later on the program. Peter Chair of Academy Securities. Equities right now pulling back just a touch. Still positive on the session by 0.1%. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. A massive salvaging effort is underway with crews clearing debris from the destroyed Francis Scott Key Bridge in Baltimore. This as ports along the U.S. East Coast are modifying their operations to absorb cargo diverted from Baltimore Harbor. The fallout is expected to be largely contained as neighboring facilities with spare capacity tweak their schedules. UPS up in pre-market trading after announcing it's expanding its partnership with the U.S. Postal Service. In a statement, UPS says after an initial transition period, it will become the primary air cargo provider for USPS. This coming as its rival FedEx says it was unable to reach an agreement to extend its contract with the U.S. agency. Gold is hitting another record on bets the Federal Reserve is getting closer to cutting rates this year. The precious metal jumping as much as 1.6% from Thursday's close. Strong buying also coming from central banks, particularly in China. Consumers there also driving up demand amid ongoing problems in the world's second largest economy. That's your Bloomberg Brief. John?
Just a series of all-time highs there over the last month or so. Yahara, thank you. Up next on this program, preventing the next banking crisis.
We feel very good. Does that mean banks might fail? There's been thousands of banks have failed across the last 30, 40 years. That's what happens. Business models change. But on the other hand, the quality of the banking system is strong.
That conversation just around the corner, live from New York. This is Bloomberg.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 35, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do three things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.